Good morning, everyone. On behalf of Safest Society India, I welcome you all to today's speaker session. Our guest today is one of India's most respected value investor, teacher, and thinker, Professor Sanjay Bakshi, known for using multidisciplinary thinking, psychology, and behavioral finance in his art of investing. Our association with Professor Bakshi at the Jalit chapter goes back a long way. I think his first talk on the chapter was way back in 2012, and since the last 13 years, we would have probably more than a dozen occasions where he has presented on our platform. All his talk and association, and we are very grateful for that, has been pro bono. For the society regulars, I don't think he need an introduction, but for some of our younger members and online audience, I'll go ahead and make it. So Professor Sanjay Bakshi is a distinct adjunct professor of finance at Flame University in Pune, where he teaches behavioral economics, business and investment analysis to undergraduate students as well as experienced investors in executive programs. Previously, he was adjunct professor at MDI Gurgaon, where he taught value investing, behavioral economics, and forensic accounting for 21 years. He is also managing partner at ValueQuest Capital LLP, a SEBI-registered investment advisory firm, where he advises onshore and offshore clients on their public market investments in India. Sanjay received an MSc Economics from London School of Economics and Political Science and a BCom Honours from University of Delhi. He is also a fellow member of the Institute of Chartered Accountants of India. In our speaker session, sometimes we have two presentations on the same day, but today we are making an exception and we'll have only one. We would like Professor to go as deep and wide as you would like to on today's topic, which is implementing Benjamin Graham's special situation framework in conventional investment strategies. Important to note that today's presentation is purely for academic purpose, and none of what he says should be construed as investment advice or recommendations. I'll request all of you to put your phones on silent and appreciate that you don't put any social media posts about today's session. But if you must, then please be very, very careful about what you mentioned. Thank you, and over to you, Professor.
Thank you for that. Thank you for coming out on a Saturday to listen to me. Some of you have come from outside of Delhi, so really thank you for making it happen, coming out all the way. I picked a very technical. The topic title is sounds very technical. When I told my wife that you're invited, she said, "What are you talking about?" I showed her the title. She said, "I'm not going. You go." So, but it's a topic which is very dear to my heart. It's a topic called special situations, and many of you are familiar with that term. Special situations are very special to me, and I'm going to talk to you about a personal journey of mine through the special situations and what I've learned from that, and how I use it today, how I don't practice it in the purest form, the way Benjamin Graham wrote about it in his book, in his books, but the key principles that I picked up from that discussion, that write up on this topic, is something that has helped me as an investor, and not just as an investor, also as a thinker generally, not just about investing, about life in general, and we'll talk a little bit about that as well. So what is so special about the third edition? There are these 5 editions of Graham and Dodd's book Security Analysis, and my personal favorite is the third edition. And again, different people have different editions or which they love. I love the third edition for a very specific reason. And the reason is that on the page 641, he has a very small section called special situations, in which he writes that special situations are happy hunting grounds for the salmon pure analyst who prefers to deal with the future in terms of specific measurable developments rather than general anticipation. He's basically saying that there is this class of investing where you are not thinking about markets, you're not thinking about businesses, you're not thinking about balance sheets, you're not thinking about P&Ls, cash flows didn't even exist at that time. You're not thinking about business economics, you're not thinking about cycles, you're not making predictions about where the business is going. And yet you can be a value investor in what he called the special situations. What are those? Measurable developments rather than general anticipation. Basically, he said if you are investing in normally in a stock, then you really have to think about general anticipation. In the end, how are you going to make money? You're going to make money because markets go up. The stock that you bought went up. Why will it go up? It'll go up because the price went up. Why will the price go up? Price will go up because a lot of people are buying that, and the re-rating is happening in the market. So to a large degree, it's not something which you can predict. It should happen based on value investing principles, but you can't really predict when it will happen. But then he said that if you leave all that aside, and he taught that in his books for the most part, 99.9% or maybe 95% of what he taught was normal investing. About 5% of what he taught was special situations. And this is the only this is the only edition of security analysis in which there is a reference on page 641 of an essay that he wrote for the Analyst journal, which was published. And that essay, he said, is too technical even for security analysis book, which was meant for, experienced investors, as opposed to the intelligent investor, which was meant for non-experienced investors. Even for those, he said, this is a little technical, I'm going to put it in the appendix, so that people who are not that intelligent, they can continue reading, but people who have really an interest in this field, they can go to the appendix. And I was a chartered accountant, and I was a numerate person. I knew a lot about numbers, but I had no idea about businesses, cycles, ratio analysis, all the kind of stuff that we do on a daily basis when we analyze businesses. And I'm talking about England. Actually, I had come back to India at that time. In England, I learned about Warren Buffett, Munger books. But when I came to India, I chanced upon the Institute of Chartered Accountants library. And in the library, I found the 3rd edition of security analysis. And I issued it to myself. And then I went to a photocopier opposite Ames, who used to take all the medical books of students from the library and photocopy it for them. So I got this whole book photocopied for me. It's still with me. It's the most precious book of mine. Photocopied edition, the 3rd edition of security analysis. These are the scanned pages of that essay that I'm not going to open them up for you. You can do that on your own. In this essay, he wrote about what is the meaning of special situations. And he talked about various kinds of special situations that exist. And he said you're basically trying to profit from a specific corporate event, not markets. There is a development. There is some development. And that development could be a merger, could be a takeover, could be a stock buyback, could be a recapitalization, could be a bankruptcy workout, could be a spin-off, could be a liquidation. It's event-driven. It's nothing to do with markets in general, economies, and therefore it is uncorrelated. And therefore the returns from what you make over there doesn't matter what the market does. Market takes a tank. If there's a tender offer out there at $100 and the offer is from a person who is creditworthy and he has the money in the bank and he's put the money in the escrow account and you bought the stock at 80 and the offer is at 100 and he has to pay the money to you in 5 months and the market tanks, you'll get your money. Therefore, if you think of it from the point of view of the the attractiveness of this particular opportunity in a portfolio, it's got zero beta. It has zero correlation to the market. You make your money regardless. The opposite is also true. The market goes up 100%, you're not going to make more money. You're going to make exactly what you're promised. So he said there is this class of investing that you can do where you're betting on the happening or the non-happening of a corporate development, something about the company, about the business, some event, what we call as event-driven strategies. Now we call it risk arbitrage. These terms were not there at that time. And in this page, if you see here, there is this second page over here. Second page, sorry. Over here, there is a formula which I zoom in and he gives you the formula. And it's a very simple formula, it's logical. He says, let's figure out, the calculation goes beyond the lure of yield book. We are willing to make, if you are willing to make the necessary assumption, the attractiveness of a given special situation can be expressed as an indicated annual return in percent with allowance for the risk factor. Here is the general formula. Let G be the expected return in points of the event of success. L be the expected loss in the points of the event of failure. C be the expected chance of success, which means the chance of failure is 1 minus C. Y be the time on which you will make this money. P be the current price of the security. And you calculate very simple, it's expected return calculation. We all are very familiar with it. Basically, what can I gain? What is the upside? What can I lose? What is the downside? What is the probability of the upside? What is the probability of the downside? And put it there. Now the problem is that when you were in school and you studied probability, you were told that you know exact probabilities. You know exactly what is the probability of drawing, two sixes and throwing 2 dice, on the floor, or what is the probability of landing 7 on the roulette table, or what is the probability of getting 3 aces in a draw of cards. These can be calculated with exact precision if the cards are fair, as the coin is fair. In the world that we are taught about in school, in courses in statistics, we are told that probability is very objective. You can calculate with precision as to what will be the exact probability of this event. And there's no ambiguity about it. So the various possibilities and the exact probabilities. Notice the point I'm making. The various possibilities, all the possible scenarios. You can define them. Permutation combinations. And you can also calculate with exact precision what the exact probability of a given event will be. And from there, you learn a lot about probability. Now you get out of school and come into the real world. In the real world, we don't even know the scenarios, let alone the probabilities. So now we are jumping into the world, the practical world, where it's a probabilistic world, where there are all these things that are happening. I don't even know what is going to happen. And yet, I have to figure out a way of trying to incorporate this uncertain world with all these possibilities. And he says that in the sense that applies to the world, but it's not easy to do that because, the more you move toward the casino or the dice or the urns in statistics books, the more accurate it becomes. The more you move toward the real world, the more messy and difficult it becomes. Special situations come in the middle. They come in the middle because there are ways of thinking about the various scenarios. There are ways of thinking about the probabilities of those scenarios. And I built a career around that in the early part of my journey, and I'm going to talk to you about that. And I learned nothing is new here. And many of you are practicing special situations, I'm sure, would relate to what I'm saying. So, risk arbitrage is dynamic in the sense that it's not static. Things are changing all the time. Let's talk about the time factor. There's a tender offer at $100. The price is $80. 3 months are left. The price remains 80 and 3 months become 2 months. 1 month has gone by. obviously the expected return for a person who buys the stock today has suddenly gone up, because you can make the 20 bucks in 2 months instead of making it in 3 months. The IRRs goes up immediately. So as time changes, your returns change, other things remaining the same, but other things don't remain the same, they change. There are external influences. They can be specific event outcomes. They can be unforeseen changes. Some old assumptions will become absolutely illogical. As we'll work through that. I'll give you a lot of examples. There will be a time when you might come to the conclusion that I should move out of this situation, even though there is still money to be made, because the risk in the situation is too much given the returns that are left. Because you're always worried about some event, some unknown risk that might come, which might blow up this transaction. So let's say, just very simple intuition I'm going to give you. Let's say that the tender is at 100 and the price is 80, and you bought the stock at 80, and now 3 months are left, 2 months have gone by, and the stock has shot up to 96. You already made from 80 to 96, 16 bucks out of the total max that you could have made 20 bucks. You already pocketed 16. You could sell it today and make 16. Only 4 is left. If you calculate the remaining 4 over a 1 month period, the IRR will still be very good. Making 4 bucks on 96 bucks of investment over a 1 month period is not a bad IRR. You can do the math. The smart arbitrageurs would walk away from this transaction. This, I made enough money. Let somebody else make the rest of the money. There are very important lessons that you get from this as you think about this in the other side of investing, value investing. That when to walk away, when to think that I made enough, let somebody else eat. I've eaten enough, let somebody else eat from the table. The risk of staying in this is now, because some shit happens, it's gone to 96 and suddenly there is an event where the acquirer suddenly files for bankruptcy. And oops, he says, I can't fund this offer. And SEBI says, no, you have to fund the offer because you have already made the announcement, and the matter ends up in court. He eventually funds the offer, but the matter goes up in court and it takes 2 years. You'll make that 4 bucks, maybe some interest in 2 years. So when you are in that situation, when you made 16 out of the 20 that max that you could have made, you are worried about, you start thinking about risks that nobody can think about. You develop the worry gene. You start thinking about risks that nobody is visualizing. And that is a very, very important skill to imbibe in life in general, and obviously in regular investing, as we will see as we go through examples as we go along over here. Then you have to think about allocation. How much money do I put in this? And I again learned this the hard way, as Charlie Munger famously said, that you don't have to pee on an electric fence to learn not to do it. So I have peed on electric fences, so you can learn not to do it by just watching me describe how I peed on electric fences rather than watching me do it again, which I will not. Position size is important because, if you get overconfident about something, you will end up having too big a size. Because, if you really think about it, the guy who makes the most money is the one who has the highest conviction idea and a lot of money in that idea, and the idea worked. And he gets counted. But the guy who goes broke also had the highest conviction idea, and he had all the money in the idea, and the idea didn't work, and he's not shows up in the statistics because he's dead. He's gone out of the statistics. He's broke. So we have to worry about sizing of a position. There are all these things that happen. Deals that were almost sure get rejected by stockholders. We have seen that happen in buyback resolutions. In today's world that we live in, many of the resolutions require a majority of the minority. And suddenly you find that a company wants to do a going private transaction. The price at which they want to take the company private is very lucrative given the current market price. A lot of arbitrageurs get in, but it is subject to shareholders' approval. And in the shareholders approval EGM, the majority shareholders cannot, the controlling stockholders are not allowed to vote. The majority of the minority shareholders have to vote in favor. And some guy who holds a lot of shares, he says, I'm going to hold out for a bigger price. And he says no. And the deal collapses. Obviously, the stock will collapse. So you can see that this is a very interesting area of investing, where there are these lot of twists and turns. There is a lot of roller coasters. There are a lot of unforeseen developments that keep happening. And because of those unforeseen developments, the market prices also go up and down like a yo-yo, because market prices reflect to what is happening. And human nature being what it is, people overreact to those developments also. And therefore, for the savvy value investors who are good in special situations, that gives them an opportunity to even buy more, because they think this is a short-term problem, this will go away. So we'll talk about that also. You may end up with a regulatory disapproval. Two mergers are going to take place between two companies, and it's lovely synergies. Everybody is the swap ratio is very good. Everybody does it. CCI says no. Deal collapses. A lot of things can happen. But so how do you go about thinking about probabilities? So one of the things that you develop as you go through life in this field is very transaction oriented. You have to spend a lot of time spending on all kinds of transactions. You start seeing patterns. You start seeing patterns like, that if an offer is coming for buying shares of a company by an acquirer, and the company has been around for more than 100 years, then there will be a lot of shareholders who will not tender their shares for all sorts of reasons. They won't tender because they're dead, they lost their shares, they've forgotten, or maybe for some reason they bought the shares at a very high price during the previous bull market, and the stock today is selling at like 30% of the previous high or their cost, and they are subject to sunk cost fallacy, and therefore they don't want to sell because they don't want to sell at a loss. So for all sorts of reasons, the actual number of shares that will get tendered is way less than the number of shares that can be tendered, legally speaking. Which means that, practically speaking, the acceptance ratio that you will calculate will be based on some judgment about how many shares will come in. How do you make that judgment? You make that judgment by studying dozens of similar situations in the past and figuring out what are the various aspects which affect the acceptance ratios. And it can get very, very fine. And how old is the company? What is the stock, shareholding pattern? How many individual shareholders are there? How many institutional shareholders are there? And so on and so forth. And we'll talk a little more about that as we go forward. You have to think about how much time will it take for the merger to happen. For example, if two companies are merging in India and both of them happen to be in Maharashtra, the merger takes much less time because Maharashtra High Court is very efficient as compared to if you had one company in Tamil Nadu and one company in West Bengal. Two different states, two different high courts, one of them in West Bengal. Sorry if you are from West Bengal. It will take much, much longer. And you learn this from experience. You even get down to the point when the judge who is on the court, who is listening to the judgment, his past behavior in deciding similar cases will help you decide that which way he is leaning. I've gone and sat in court judgments, figuring out how a particular event will, which way it will go. You sometimes are looking at David versus Goliath cases. There was a company called Indraprastha Gas. There's still a company called Indraprastha Gas. They were attacked by PNGRB. PNGRB is the regulator. And PNGRB said, we're going to regulate your profits. You're not allowed to. So they went to court. And of course, the stock went haywire and regulated. And IGL was very spectacularly profitable. The stock tanked. All those things happened. Long story short, Supreme Court said, you can't regulate IGL because You came into existence after IGL came into existence, and IGL came into existence after Supreme Court case of MC Mehta versus Union of India, which was a pollution case, which required the government of Delhi to require CNG to be brought into public transportation in India, required IGL to be set up. They preceded you, and therefore you can't regulate. Then PNGRB said, no, we can regulate. Then they found a loophole. Loophole was that the marketing margin cannot be regulated. You can regulate everything else, but you can't regulate the marketing margin. You know the real reason why I feel IGL won the case? Because they had Harish Salve on their side. And it matters. Because when he charges 50 lakhs per hearing, you get what you pay for. And when you are having a PNGRB who's got a government lawyer who gets paid 50,000 bucks a month, then you know it's an unequal battle. And when PNGRB has taken IGL to court, the stock has tanked. And Harish Salve is going to appear in Supreme Court on behalf of IGL. You can think about the probabilities. And you know what I'm getting at. That this is how interesting it becomes. Arbitrage, risk arbitrage. The word risk arbitrage is very interesting. Arbitrage by definition means risk-free. You know, there are two markets, cheap here, expensive here, buy cheap, sell short. Risk arbitrage means there is an element of risk. There is some risk. And it's worth taking. It's priced in. Despite the risk, the transaction makes economic sense. Then there are these hedging operations that you can, and again, I'm not going to go into the deep complexities of how this thing works because I'm not doing this anymore. I'm just trying to sort of marinate you into how interesting this area was for me, maybe for you today, and what a lovely field it has been for me to be a student of, and what I took out of it, even though I left it, and how I use it in the field that I am in right now. So you can go long and undervalued security and short and overvalued security because it's available in FNO. The problem with that is that the merger is going to happen after 8 months, 9 months. But the futures are only available for 3 months max and they are not liquid. So the 1 month future is the liquid contract. So you have a rollover risk. And I've had, the kind of, I should not use that word, problems that I've encountered is in, what risk arbitrage teaches you is that you start thinking about risks that you didn't even think happened. So there was a so-called hedged strategy that we had. We were long some CPPS of some media company in a network 18 something. They had issued some cumulative convertible preference shares and they were splitting into 5 securities. You could go long the cheap one and short the other ones. And we had done that and we locked in our return. And we were so happy, we are this cheap, this is expensive, we are locked in our return. Suddenly SEBI announces, SEBI or NSE announces that this security is no longer available in FNO. Out goes my hedge. The only perfect hedge that you have is in a Japanese garden. So, and then there were these unhedged positions. The time when I was doing this thing, there was no derivatives. There was no futures, there was no options. And yet you could do risk arbitrage by doing certain things, which I will talk about. We'll come to that. So I've talked about cost. Then, this is not important, delisting I've already talked about. Graham talked about the appeal. He said that it's very intense, it's transaction intensive. You have to be very alert. It's not like trying to predict the competitive advantage of a business and then going to sleep and then wake up after 10 years and be very rich. You have to be alert because you are betting on what's going to happen in the next 5 days, in the next 10 days. And you don't want inside information because that will put you in jail. You have to only respond to publicly available information as it is coming in. So it appeals mightily to one class of temperament for the very reason they leave other people cold. They lack industrial glamour, speculative, dynamite, or more sober growth aspects. But they do afford an analyst an opportunity to deal with security values very much as a merchant deals with inventory, calculating advance the average profit and average holding period. It's like business, धंधा. मेरे पास ये inventory है, ये मैं इतने में निकाल दूंगा. And when Graham was doing it, it was a profession. He was doing 30, 40 transactions. At one time, I was doing 10, 12, 13 transactions at any given point of time. And the amount of effort that is required to monitor what is happening in those 10, 12 transactions was not small. And you can imagine how difficult it would have been in the world when we had no AI or anything of that sort. So in 1999, I wrote a column, which is on my website, and I talked about various kind of special situations that I had done till. Notice that I came back to and I started my journey as a value investor in 1994. I'm only 5 years into the profession. I'm still a rookie. I'm just learning the art of investing, and one of the first things that I learned was special situations, because I felt it's very hard for me to predict what business will do, how cycles will turn, what will steel do, what will copper do. I had no idea what is the meaning of a competitive advantage. I had no idea about low-cost operator. The word moat did not even exist at that time, I think. So I said, ये तो समझ में आता है मेरे को. This is not difficult to do, and therefore I had developed a way of. So I basically took the special situations essay of Ben Graham and I digested it. It became part of my bloodstream. That how can I use these ideas in India? And I was like a kid in a candy store when I came to India, 94 to 99. And I'll show you what you mean by a kid in a candy store. That the kinds of inefficiencies that I found in that space were like mind-blowing. Case 1, Anagram Finance. So this is mentioned in this document. You can go to my website, it's there somewhere. 1999, I wrote this column. So I reproduced what happened in one company, Anagram. So this company is in financial trouble, and suddenly ICICI, not ICICI Bank, ICICI Bank did not exist at that time, ICICI Limited, the financial institution, decided to bail out Anagram Finance in a merger. So Anagram Finance is merging into ICICI, and there's a swap ratio. And it's mentioned over here. The whole swap ratio is mentioned over here. Everything is mentioned over here. At the bottom of the document, there is a para. Also, specific provision has been made in the scheme for equity shareholders of Anagram Finance Limited, whereby they shall have the right, if they so desire, to sell the equity shares held by them in AFL to specified entities at a price of $18 per share, fixed price offer. These specified entities shall be entitled to receive shares of ICICI in respect of such equity shares purchased by them from AFL shareholders in the same swap ratio. So ICICI said there are some entities which we have funded them. They are willing to buy out these shareholders at $18, and those entities will then dump the shares in the swap. They will get the shares of ICICI. Which means you had a choice. You could either go for ICICI or you could dump your shares in the tender. Obviously, I find it very interesting. So I check out what is the stock price. Stock price is $12. I start buying. My average cost was $15. I was the only guy buying. Can you imagine a world, something like that happening today? I'm buying stock at $15, average price, started buying at 12. There's an offer out there. Effectively, I'm buying a bond issued by ICICI with a maturity in 3 months' time, with a zero coupon bond issued by ICICI with a maturity of $18, 3 months maturing from now. You can calculate the yield to maturity. And I'm paying for it $15. 6 months, sorry, not 3 months. What I didn't realize was that in those days, physical shares were there. And I was buying for myself and a client of mine. And I ended up buying lakhs and lakhs of shares. And when they started arriving, because they're all physical, this room from that end till this end was full of share certificates. And as I was the power of attorney, I had to spend 3 days signing those share certificates. And I had to send somebody by air to take them to Anagram Finance office and get them transferred in my name, in the client's name, and then only you can tender. Very, you don't realize that these things happen. Today, you press a button, money goes out, the shares come in. You press a button, the shares go out, the money comes in. T+1. Those guys who are new in the market, you have no idea as to how wonderful Indian markets have become. And you pay 0 brokerage, we pay 2%. 200 basis points. Case 2. And it gets insane to insane. You're going to see the insanity that was occurring at that time. This is SBI Mutual, one of the most respected mutual fund houses in the country. What did they do? In 1991, they launched a scheme in 1991, equity scheme. I'm not joking. You're going to say this fellow is, hallucinating or what? But everything is factual. You can check it out. They launched a fund in 1991, and the fund said, we will run this scheme for 10 years. After 10 years, you will get NAV or 3x your money, whichever is higher. Notice, this was the Harshad Mehta days. He was still ruling the Indian stock markets. He had not blown up then. There was so much dopamine in the markets that SBI Mutual launched a scheme giving guaranteed returns to investors of at least 3x trebling their money in 10 years. Or higher, whichever is higher. Well, Harshad Mehta happened, all shit hit the ceiling, things didn't go as planned, they never go as planned, bubble burst, NAV collapsed. Fast forward to 1998, NAV has fallen below 200, the offer is at 300. No, notice there is no way from 1998 to 1999 when the scheme matures, May 1999 the scheme matures, the 200 will cross 300. So it's basically that will SBI Mutual pay $300? NAV gaya bhar mein. NAV is $200, below $200, I'm buying at 220. I'm buying at 220. I kept buying till my average cost became 245. So I'm buying. My average cost is 245. Why am I doing it? Business Standard, 22nd June 1998. Nematullah, Managing Director, SBI Mutual Funds, SBI Funds. The NAV of the scheme is well below the desired level. It's a matter of concern. We're trying to do our best in the circumstances. We will meet the assured return commitment. Financial Express, 2nd February 1999. Chairman of SBI. Not SBI Mutual, Chairman of SBI. Not the asset management company, the holdco. India's largest bank. Public sector. Sovereign. This is Government of India talking. We will extend full support to our subsidiary SBI Mutual Fund to redeem the assured return, even if it means taking a hit of 150 to 170 crores. The exact amount of the liability will crystallize in May when the scheme is due for redemption. We will make the provision for this fiscal. It's a minor shock for us. Minor shock for you is, I love. With this promise, the units of SBI Mutual Triple Plus were transformed into a zero coupon bond of State Bank of India with a maturity of 13 months later and a redemption price. So I calculated till what price I can buy. So I can keep buying. I set the price. I stopped buying when it stopped making economic sense. I want 20%. I could have levered this transaction. In my personal portfolio, I levered this transaction. I'm borrowing money, hopefully from SBI, and lending money to SBI. it gets better. 1999, UTI, UGS 10,000. Only invest in blue chips, MNC blue chips. 20 companies portfolio, blue chip companies. In those days, number 1999, Chandrakant Sampath kind of stocks. The Nestle's, the Unilevers, the Colgates. That's what they had. And they always did very well. Now, if you invest in an open-ended mutual fund, we have the expert of the person who sells mutual funds as his day job, right, sitting with us. Open-ended mutual funds are open for business on a daily basis, but investors who are coming in and going out are, getting NAV, daily NAV, which is calculated. What is the NAV? What do you own today? What is the market value of that? Minus if they have any liabilities, minor, and the number of units outstanding. You're calculating on a real-time basis. Every day, the NAV is calculated, right? Interval funds have defined periods that they open for business only for a period. In this case, it was 7 days. Unique thing about UGS 10,000 was that allow you to time travel, which means that for the first 7 days of a month, you could buy in and exit at the NAV that was there on the closing of the last month. So if the NAV of 28th February is known to you, you could invest as much as you wanted in the scheme on up to 7th March. As it happened, in 1999, we had a finance minister called Mr. Yashwant Sinha, and he announced what we called as the dream budget on 28th February. And as a consequence of that, the stock market just went up like a rocket. And now we are on 5th or 6th of March. And now we have a bunch of companies, a portfolio of companies, blue chip companies available to us at the NAV of 28th of February. So this friend of mine lives in Defense Colony. He was a childhood bud of mine. So UTI used to, at that time, come out in vans to help senior citizens apply for securities, mutual funds, and form and all that. They would come to the various locations in a van, help you fill forms and all. And there was a limit on how much forms you could submit. So I followed that van all over the city. पैसा ले लो, मेरी माँ का भी ले लो, मेरी बीवी का भी ले लो, बच्चे तो थे ही तब, सबका ले लो, बच्चे थे, मैं बहुत छोटे थे. I went and my friend invested. Then I said, you go home. Then I chased that van all over the city, finding money left, right, center. Because notice, when you find an opportunity, usually there's a liquidity problem. This is a fund which is an open-ended fund which can take as much money as you want. This is the period that I have come out of. This was reported ultimately. And then obviously they went open-ended. They realized that what a defective structure it was. I didn't make any money by creating value. I make money off the old investors who are still in the scheme. Because there was a whole rush of money into the fund which diluted the old investors. In 1998, Ponds merges into Unilever. According to the merger scheme, for every 4 shares of Ponds, you get 3 shares of Hindustan Unilever. At the time, it's called HLL. In mid-1999, last few days on which the Ponds was traded, so there are only last few days of merger. So therefore, the swap ratio, the two stocks should be trading, based on swap ratio. That was not happening. But there was no hedge. So I could not go long one and short the other one because there was no FNO at that time. But I said, well, okay, I can't hedge it because Graham talked about hedging in his merger arbitrage. But this is Unilever and it's only a few months. And Unilever is a lovely company. Can I create cheap Unilever shares through Ponds? I buy Ponds cost of 4 shares of bonds comes to 5016. For this 5016, 3 shares of HLA will come to me in 3 months' time. The cost come to 1672. But they are selling it, those 3 shares are selling at 1962. So it's a chance lene ka. That's what risk arbitrage is. Okay, you don't put all your money in these things. You put some money in these things, maybe a lot of money in these things, maybe 10, 15, 20% of your portfolio. Remember, if you put 20% of your money in a situation like this, 80% of your money is not in the portfolio. So even if it blows up in your face, I mean, it may turn you from a short-term speculator into a long-term investor. It was not some shady company. It was Unilever. So you could take the chance. So I'm getting a chance to buy Unilever. This is what it boils down to. I'm getting a chance to buy Unilever 15% lower than the market price. And I'm not buying some shady company. And it's the same group. There is no regulatory risk. There is no financing issues. There are no such normal, issues in merger transactions that are there. In those days, there was no CCI, nothing. It was just a matter of time that this would happen. As it happened, you get lucky. By the time the shares came, the stock shot up to those 1672 became 2400 because levers went up, because suddenly the market started thinking, oh, Unilever has got bonds in it. Bonds is a lovely company. Unilever with bonds is worth more than Unilever without bonds. And Unilever shares went up and 60% IRR. Notice last few days, the spread. Do you think it can happen today? Why can it not happen today? FNO aa gaya hai. And what is that company which is being investigated by SEBI? Yeah, wo bhi aa gayi hai. Now these inefficiencies can't last for more than a few microseconds. But they were there. It gets better. 1996. This is like the most insane thing I've done. I keep on looking at things. I said, this is the most insane thing I've done. Then I find something else, which is even more insane that I've done. So I don't want to actually claim this is the most insane thing I've done. I just said this is one of the most insane things I've done. So Nirma is a well-known listed company at that time. Very profitable. We all know, we have all seen the commercials as children. Those of you who are old enough would have seen the commercials, and lovely brand and everything. And stock is not expensive, 10, 11, 12 times. Again, it's an Indian company. FMCG Indian companies were not priced the way MNC FMCG companies were priced. In 1996, they come out with a rights issue of NCDs. $200 ka face value. Okay. Now, for every 2, they give you one NCD or SPN, special payment note, whatever they call it. You got a warrant. Sorry, you got a NCD. Notice the rate of interest. The interest rates at that time was 17%. You're getting 17% from Nirma on a bond, which came with warrants attached. There were 4 warrants attached. For NCDs are allotted on 15. 4 detachable warrants were attached. Series 1, 2, 3, 4. Now, what were the terms of the warrants? Each warrant give you a right to acquire additional share in Nirma for just $50. That means exercise price is $50. Stock price is way above that, so it's deep in the money warrant, right? And you're not paying anything, so you're not paying, it comes attached to the NCD. So whatever you pay for the NCD, on that you get 17% and you get these 4 warrants. So I was not lucky enough to subscribe to these warrants, subscribe to the NCDs. Therefore, I did not get these warrants because I was a subscriber to the NCDs. I was not a bond investor, I was a purely stock investor. I never looked at it, I should have, I missed that. But these warrants got listed at some point of time. Now, notice the mechanics of it. There is a company which has issued warrants. These warrants are 4 series. They will be maturing over different periods of time. One of them is maturing on October 15, 2000, then 2001, 2002, and 2003 at $50. You pay $50 on these dates and you get 1 share of. Obviously, if the price of the stock is way above $50, then only you will pay 50. This thing. If this is the exercise price, if the stock price has to be, stock price was more than $200. So you only exercise the warrants if it makes economic sense at that date. Today, if the warrants were to be exercised, it makes enormous sense to do it. But they're not maturing today. They're maturing many years from now. It's March 1998. Notice only 2 years are left for the first series to expire. Minimum stock is 360. Exercise price is 50. Therefore, the warrant should trade at 310 minimum plus time value. You know Black and Scholes. Simple math. You don't even need to know Black and Scholes. The minimum price at which every warrant should sell should be 310 plus. This is a quotation from Financial Express. Who's wondering why is it so low? Why are these warrants selling at low? And they are actually responding to what I was doing in the warrants. So I'm buying them at $95. I'm buying them at $96, $93, $127. The fair value is 310 plus time value. I'm buying them basically. I'm thinking only one year is left for the 2000 series, 2 years for the 2001 and so on. I'm creating cheap Nirma shares. I can calculate the P multiple that I'm paying and all that. I can calculate the dilution, but the dilution was not there significant because there will be money going into the company for new shares being issued. And the amount of warrants and the number of shares that would be issued were not very large compared to what was already in issuance. So it was not a dilutive sort of a provision. So I'd done all that calculation. Now in those days, obviously there were physical securities. They would come to you and it turns out that almost all the deliveries were coming from a certain broker from Gujarat. So I picked up the phone and called that broker. He said, why are you selling all this? He said, we have a client who is in financial trouble. The name of the client is Gujarat Lease Finance. I said, और है? I said, बहुत है. I said, सब दे दो. So we did an off-market transaction with them. Took it all for the client. I didn't have money anymore to buy more, but the client had. We took everything. And we got lucky. Few months later, they came up with the scheme of arrangement. They said, let's shrink the time of 2.3, 2.2 and 2.1 and to make it 2000. So luck favors the prepared mind. Lady luck shines. If you do your work, you get lucky. There was nobody competing with us. Who would want warrant? The series ही अलग होता है. People are looking at 30 scripts, illiquid. I'm buying 50 warrants, 150 warrants, 200 warrants, 500 warrants, but then off market, big quantity. Buffett has written on risk arbitrage many times. I'm just reproducing some of what he has said, and I'll now talk about his thoughts, how they've evolved over the years and how we can learn from that, how I learned from that, how we can all learn from him. He says the same thing which Graham has written essentially. How likely is the probability will occur, which means that the probability will not occur is 1 minus that will occur. How long will the money be tied up? Time factor. What chance is something else will transpire? He brings in another factor, which is that if he's doing competing, he saw that in wholesale takeovers, sometimes there's a better bid that comes along. Sometimes acquirers revise the price upwards and so on and so forth. What will happen if the event does not take place because of antitrust action, financing glitches, etc.? That is, the deal collapses. What are the consequences? Not the probability of it. The probability is already captured in 1. The probability of deal happening is captured in 1. The probability of deal not happening is already implied in 1, which is 1 minus the probability of deal happening. but the consequences are captured in in the fourth one. Then what is the worst case scenario? Again, the same thing. How much do I make if things work in my favor? What are the chances that they will work in my favor? How much do I lose, if anything, if things don't work in my favor? What are the chances that they will not work in my favor? And how much time do I have? That's all there is. In the end, that's all there is about everything, actually. If you can reduce everything into these four things, and it's not easy in most cases, but in some cases it becomes useful, as we will see how to use that framework. This is what the talk is about. Right now we are just marinating ourselves into how risk arbitrage was practiced by Graham, by Warren Buffett, how I in my own way practiced, stumbled upon it, and made some mistakes along the way and learned a few things. He writes in detail about an investment that he made in the opportunity of risk arbitrage called Arcata Corporation. So this is a company which is into redwood forests. So they own very large land which has these forests, trees, wood, timber. Expensive. These things are worth a lot of money. But the government acquired it compulsorily and said, here is the check, we are taking it over. It's like, in India we acquire land and government goes to people whose lands are acquired, they go to court and courts are then talking about how much compensation and all that. So there was a court case on. So there's a company which is listed called Arcata Corporation, which has one of the assets they had is this land, which is under litigation, which has been acquired. They have lost the ownership and they have received compensation, but the compensation is not adequate according to the company, and they have gone to court against the US government and they have filed a case. So there's a contingent claim as an asset. We had normally talk about contingent liabilities. So so the value of this company is the value of the company as it is without this contingent claim plus the value of this contingent claim, right? So they were all this. They gave $97 million. They was inadequate. So there was a case going on, and they also said that beyond the compensation amount, the dispute arose over the interest rate applicable for the period between the land taking and the final payment. They were paid only 6% simple, not even compound. And the company said, no, this is too little. It should be compound interest. It should be compound rate of interest. Everybody pays compound rate of interest. Who pays simple rate of interest? And moreover, the 6% is too low. So this was the basic thing. The 97, three things: 97.9 million, too low; 6%, too low; compound, simple interest, not acceptable. It should be compound. 3 points. Arcata then decides to put itself for sale to KKR, Kohlberg Kravis Roberts. And there's a tender offer. And Buffett is looking at it. But the problem is KKR are very smart people. How do they pay for this company? How do they decide? Because if they pay for this company, the Arcata Corporation want to say, look, we have this wonderful claim. If you get this money, it will be a wonderful amount of money. So it's in the value. Pay us this money. But there's a chance that they will not get this money. So KKR is going to say, no, we are not going to pay this money because this is not your value, because it's not done yet. It's not, money is not in the bag. It's not in the bank. So it's a negotiation problem. One guy is saying, give me everything. One guy is saying, I'm going to give you nothing. So KKR was very creative in the transaction. They said, we will give you this much for the company, plus we will give you 2/3 of any additional compensation received from the government. Give us the company. We'll fight the case on your behalf. We'll continue fighting. If the company wins the case, we keep 1/3. We'll give you 2/3. So 2/3 of the money goes to, it's very similar to VSNL land case. Those of you who are familiar with that situation, Hemisphere Properties. To address this complexity, KKR proposed a unique offer, $37 per share, plus 2/3 of additional compensation received from the government for the redwood lands. And the stock is trading in the market. So this deal has been announced. There's a tender offer on the table from KKR. Buffett is looking at the news flow. He is thinking, the risks, KKR, he says they are very reliable. I don't have a problem with them. I trust them. They have very strong track record. They're a world leading private equity firm in those days. They were called leverage buyout firms. And he also wrote about what happens if the deal falls. For whatever reason, you see, you have to incorporate. This is the point I'm making here. No matter what, you have to think about the consequences of deal failure. Even if the probability is very low, put the consequences. And we'll talk about what happens when you don't put the consequences. You may think the probability of an adverse outcome is very small, and therefore there is the propensity to ignore it. Buffett doesn't do that because he's learned from risk arbitrage. He said, I know the chances are low, but what is the deal falls? And he says, well, no problem, somebody else will come, because in the US the M&A market is very well developed. If a company is in play, people come forward. If KKR drops out of the game, somebody else will come forward. He was very confident about that, and that's what he wrote about this over there. But notice, he is thinking about the consequences of the deal failure. And then he says, how much is the Redwood claim going to be worth? He said, I have no clue. It could be worth 0. It could be worth a lot of money. It doesn't matter. I'm not paying 37 premium or 37. I'm paying 33.5. I'm paying 33.5 to buy a piece of paper which can be converted into cash of 37 today, but I will still retain the contingent claim. 2/3 of the claim will be mine. If I buy this share and I tender it in the offer, then I will still own that, have that claim. He bought 5% of the company. He said, this is what I think I will make. 37 is the payout, 40% CAGR return, projection. He says, this is what I thought would happen. And this is, the icing on the cake is on top. And then he talks about the twists and turns in the transaction to the timeline. He said in December, there was a delay in closing was announced, but a definitive agreement was signed on 14th. Then on February 25th, the lenders decided to take a second look at financing due to terms civil depressed housing industry impacting Arcata outlook. Notice whenever these things happen, the stock tanks. Oh, deal khatre mein hai. The deal is going to collapse. Buffett is looking at it very dispassionately. He's saying, encouraged by the potential value, we raised our stake, buying at around 38 bucks per share, increasing over to 665, over 7% of the company. He said the shareholders meeting was postponed again to April, despite reassurance. Arbitrageurs called just saying he lied like a finance minister on the eve of devaluation. Basically saying arbitrageurs are very superstitious people. Whenever something bad happens, they rush for the exits. Because they thought 3 महीने के लिए पैसा लगाऊंगा, मेरे को पैसा अभी चाहिए वापस. If 3 months became 4 months, many of them said, I want out. Buffett is not like that. On 12th March, KKR revised the offer. They cut the offer down to 33.75. Notice what happens, the offer price is not done yet. It's just an offer, it's not tender. It is all subject to shareholders' approval, court approvals and all that. They cut the price because of the adverse development. They said, no, we don't want to pay 37, we're cutting it to 33. Obviously, the stock will drop. 2 days later, they revised the price to 35. Notice the amount of volatility that will be happening in the stock market because of these developments that is happening. And he's just sitting there watching it. Because he's seen these things are very common. These things happen. On 15th March, they rejected Arcata's offer and they took it from another group which paid 37.5 plus 1/2 of Redwood recovery. Instead of getting 2/3, you get 1/2. So you get money upfront, but the contingent claim value dropped. Whatever, that from 2/3 you get. For an arbitrage, that's still very cool, right? Because your cost basis is so much lower. That's a lottery ticket for which you're not paid anything. And that's what value investing is. Collecting lottery tickets for which you don't pay anything. He said, this thing happened, deal was happened, I got paid June 4th. Then we got 24.6 million against some cost of 22, so made their money. 6 months average, 15% CAGR, lovely. But then what happened? 1987. So we are in right now, what is happening? This happened in 81, 82, and now we are in 87. Notice 5 years have gone by. 5 years have gone by, government is sitting on this amount. 2 commissions are appointed. One value of the redwood, the 275 million. That means jump in the value of the claim, and they turned it into compounded 14% from 6% simple, and you get paid for the 5-year wait also, compounded CAGR. They said, they went to court, the government, judge upholds conclusions, indicate net amount of 600 million was due to Arcota, government appealed, then they went settlement, they settled for 519 million, they had to pay him 29.48 per share, he got another 19.3 million on his investment. Notice how much he made in the previous one. On 22 million, he received 24.5, 24.6, and then he got additional 19.3 million. And he got 800,000 expected 89, subsequently substantially revenue. And that's what uncertainty is. If you get exposure to some future favorable events, possibilities, it's not sure, some possibility, but you haven't paid for it. It's a good problem to have. It's a good situation to be in. And you can incorporate that in your thinking about the future, how you think about investing. For example, in normal investing, and I'm jumping because I've not incorporated that in this deck, so suddenly remembered. When you are a value investor, you're looking at a business which you love in terms of the competitive advantage and the people and the product and the disruption risk and the balance sheet quality and the entry barriers. And you find for some reason or the other, it is selling at 8 times earnings. And if you look at a bond market, pre-tax earnings, and bond markets are yielding 9%. So bonds are giving you, a sort of a return which is higher than the earnings yield on the stock, right? The stock is cheaper than the bond, and bond will never grow its earnings. Stock may grow its earnings, should grow its earnings, because you've done the maths, a growing industry, everything is wonderful. They have very high return on reinvested capital. There are very clear signs of growth coming. They are doing capex. There's clear demand. They have order book. Everything is there. There is clear growth visible, but you're buying the stock at 8 or 9 times earnings. And in the bond market, you can buy bonds at prices such that the PE multiple that you're paying for the bonds, which will never grow their earnings, are higher than what you're paying for the stock, which means you're not paying anything for growth. That growth is the lottery ticket, that redwood claim. And you can collect this over time. Basically, not growth at a reasonable price, not growth at any price, but growth for free. That's the best lottery ticket. And why do you get that? Not subject matter of this discussion, but you get it. You get it in hordes. And when I say horde, it doesn't mean a few dozen opportunities every year. You get 3, 4, 5, 6 opportunities every other year. You don't need a lot more than that. No, not right now. Questions after I finish, please. Now, what did risk arbitrage? You can note down, please, the questions that you have. What did risk arbitrage teach me about life? The first lesson that I got was obviously that life is a game of probabilities. But they are subjective probabilities, not the kind of probabilities that we are taught in school. In school, the courses in statistics and probabilities, they teach us the mechanics of it, but the real world is very different from the world of statistics and probability books out there. There are massive asymmetric payoffs. You don't get asymmetric payoffs in a casino. You can make 36 times your money if you win, but you can make 2,000 times your money if you back a Google in a VC. You can make 20,000 times your money. So the payoffs of being right in the equity space, whether it is VC or deep value investing or compounders, whatever, or turnaround situations, is absolutely insane. And which means that you don't need a lot of those. If you can have only a few of those, then they can compensate for a lot of the duds or the mediocre positions. And that doesn't happen in bond investing. A very smartly selected bond in your portfolio is not going to give you more returns because the company is doing very well with the money that you've given to it. They're not going to jack up the rate of interest or the redemption on the bond because they have done wonderful things with the money that you give to them. They will still pay you the same. But if one or two companies in your bond portfolio blows up or turns out to be fraudulent, you will lose money. So there is a cap on the bond portfolio. The max return is known. That's the best you're going to get. So to make the return, you have to stay lucky. On the equity side, to make an astonishing return, you just have to get lucky once. Staying lucky is very different from getting lucky. And of course, you can position yourself to be lucky. And that's a different discussion. And not all surprises are bad. Unlike in banking, where most surprises are bad surprises. In investing, not all surprises in arbitrage or life, not all surprises are bad. We saw that what happened in Arcata. We saw that what happened with bonds. A couple of examples that I've talked to you about. We saw that what happened with Nirma. Sometimes tender offer prices are revised upwards, which are not incorporated in the prices prior to the offer. Therefore, there is a period in the tender offer which is the last date of the price offer being revised under SEBI regulations. That's an important date to think about. Because anything can happen on that date, just a few hours before that date. And usually it happens only a few hours before that date. Sometimes the competing bid comes and a takeover battle begins. And it's always a good idea to be invested in a company in which people are fighting, ki to mere ko chahiye. You just sit there, have popcorn, caramelized popcorn. You don't mind paying the GST also when people are fighting over that company. Sometimes the court throws out a case against a company which everyone thought they would love. They would lose. Sorry, not love. They would lose. So I gave an example. Senior counsels matter. You get what you pay for. And there are all these inefficiencies out there. People are trigger happy. They jump to conclusions. One adverse development and they rush for the exits. One bad news, boom, they're out. They don't want to sit and think. And now we move into that direction as to what are those cases. I'll do that in a minute. Second lesson was, if you don't change your mind, you are going to be the patsy in the game. If there is one profession that forces you to change your mind frequently, to debias you, it's risk arbitrage. Because if you don't do it, you're going to be eliminated from the game very, very quickly. Because the game changes so quickly. What made sense yesterday stopped making sense today. Offers can be drawn. You say, नहीं मैं तो average down करूँगा. Offers withdraw होगी कोई बात नहीं नीचे आ गया. Commitment bias. Now I become a long-term investor. I start thinking about PE multiples. Earlier it was tender offer. Now I'm thinking about PE multiples and margins. That will take you out of the game. It forces you to recognize that you will be wrong. And it will also make you recognize that being wrong is okay, staying wrong is not okay. Because the more you stay wrong, the more you get burned. Because you're competing with other arbitragers who have also been proven wrong. At the same time, you all have been proven wrong. So you learn to think like a Bayesian. Because new information is coming in, it's very dynamic, things are changing, variables, all those 4 variables, returns are changing, what made sense earlier doesn't make sense now, time is changing, regulation is changing, a lot of things are changing, prices are revising, so on and so forth. Third, the most important rule of capital allocation is what makes sense at one price does not make sense at another price. Now, the biggest application of this, if you think about expected value framework, this is the price I'm paying, this is what I'm going to get, this is the timeline, this is the probability of things happening if they happen in my favor, if they doesn't happen in my favor, how much do I make if things happen in my favor, how much do I lose if they don't happen, my expected return. And this is the entry price. Now, if you keep everything the same and jack up the entry price, what will happen to the expected return? Your returns go down. If you keep on jacking it up, at some point they become negative. Now tell that to, anybody who has done risk arbitrage would know the stupidity behind buy at any price ideology. Great businesses are not great investments. They can become terrible investments. You may have to wait 30 years, 20 years and not make any money. And the opportunity cost is going to be huge and may end up losing money. And we've seen that happen. So we learn how to price risk. It tells you the art of underwriting risk. It tells you the art that, okay, there is a problem here, there is a court case and there is an issue and this fellow has resigned and there is a mess and there is a liability. Yeah, but the stock's down 50%. And now from here onward, from this price, does it make sense to own? I'm not an owner of the company who owned the company earned. Does it make sense to own it now as a risk arbitrager? With this mess, with this complexity, which nobody else wants to see, you are going in because the complexity has created that environment in which the price has dropped, and you are loving that complexity and that uncertainty and the pessimism surrounding it, and you are actually moving in that direction. You are in effect underwriting that risk. You are pricing that risk. That it didn't make sense at that price, but look what has happened. And this happens very quickly. So some adverse development happens and the stock tanks for the right reason, but it has over-tanked. It didn't make sense yesterday, but today it makes sense. Now some of you might be applying it to that platform company, that exchange company. What is it? I'm not good to answer that question. There are smart people in the room who can answer that question for you. There are ways of thinking about it, but this is where we are headed. After the drop, does it make sense? Maybe before that it was not pricing. After the drop, does it become a good bet? Bad bet, good bet. At a price, a bet is bad. At another price, it becomes sensational. Time will tell. And you don't have to be right on every one of them. That's the other thing that you learn. You are like an insurance company. You're underwriting risk. If I'm an insurance company and you're all coming to me with your car driving experiences and I'm underwriting risk for every one of you, I'm going to look at your past history. Those of you who have accident every other day, I'm not going to underwrite your risk. Or I'm going to ask for a very high premium. Those of you who have never had an accident in the last 25 years of driving, I'm going to give you a very low premium. But in every time I'm underwriting your risk or giving you a quotation, my thinking is, what is the probability that you will have an accident, and what is the and therefore you will have a claim, and what is the probability that you will not have a claim? And if you have a claim, how much will be the claim? And what is the time during which it will happen? 1 year max, right? And how much should I take to compensate for that? Expected return calculation. Every policy that I underwrite is a positive value policy in my judgment, but I'm going to end up writing some claims. There will be a flood in Delhi. There will be an accident. There will be people, and the claim, if a car is costing 10 lakhs and I'm taking 25-30,000 rupees and the car is totaled, I have to write a check for like say 6 lakhs or 7 lakhs. I collected 30,000 rupees and I have to write a check of 7 lakhs. I'm going to lose on that policy, a very large sum of money in return of the money I took. Does that make me a bad underwriter? Absolutely no. So the average outcome of thousands of policies that I write will determine whether I was a good underwriter or a bad underwriter. The same exact logic applies in arbitrage. You will have bad experiences. The problem is when you write on policies, you're writing millions of policies in a given year. When you're doing arbitrage, you're doing 10 transactions in a year. So the variability is a lot more. The fourth lesson that I learned was that there are no sure things and condoms are not completely safe. So what is the idea of no sure things? So the story of this gambler who lost money regularly. One day he heard about a race which had only one horse in it. He said, "ये तो बहुत अच्छी race है, इसमें तो मैं हार ही नहीं सकता हूँ, सब लगा देता हूँ." That horse was a male horse, saw a female horse. He got very excited. He jumped over the fence halfway around the track. He jumped over the fence and he ran away towards the other horse, female horse. And they lived happily ever after. He never completed the race. The idea is that there are no such thing as one horse races. We think, ye to don't bet against the money. I mean, we have one horse races. We understand where I'm getting here. The analogy that I'm drawing here. That we take these ideas and become overconfident about how the world will play out based on our thinking about how, Anil Ambani can't get into trouble because he comes from a very wealthy family, a very rich background, and so on and so forth. But it's not that easy to come to that conclusion. The second aspect of the slide here is a famous quotation from Robert Rubin, which goes like this, that he said, "Condoms aren't completely safe. My friend was wearing one and he was hit by a bus." So he's having a good time inside with a condom on and he's hit by a bus. The idea is that the risk that will take you out is not the risk that you're protecting yourself from. You learn that from risk arbitrage. Like I said, I am fully hedged. I've got this security and I've got 4 other securities and they're all in, long and short positions. And suddenly NSE takes out 3 of those securities from the FNO list. That's a bus with me inside the bedroom, fantasizing about the returns that I'm making. Now let's talk about a very simplified hypothetical risk arbitrage example. Let's say there's a tender offer to buy 20% of a company. The stock price before the offer is say $100. And the offer is made at $220. Somebody comes up with a very insane idea that this company is wonderful, synergy and all that, competition kam ho jayega. I want to buy this company, I want to dominate the market, and he says, for me the value is 500, I am going to make an offer of 220. So he goes and makes his offer. The stock quickly rises to 90, or let's say the promoters themselves want to increase their stake from 51% to whatever it is, 20% higher. The stock quickly rises to 190, obviously, because that's what will happen. The stock will quickly jump to 190. The offer is at 220. So the spread is 220 minus 190 is 30. But the offer is for only 20% of the shares outstanding. Let's assume the controlling stockholders own 51% and made the offer. So obviously they can't tender their shares in their own offer. This means the offer is being made to the remaining 49% of the shareholders who own 49% of the shares. Assume LIC owns 20% and you feel that it will not tender its shares in the offer. It's an institutional investor, long-term player, they don't get into arbitrage and all that. The company's control is not changing, blah, blah, blah. That means that out of 49% of the shares that are with the public or non-promoters, 20% which are with LIC, the remaining shareholders are only 29%. And also assume that 10% of the shares will never be tendered due to factors such as inertia, high cost basis, dead investors, we talked about that. Therefore, practically, the 20% offer is being made to people who hold just 19% of the shares outstanding. That means all the shares will get accepted. 100% acceptance ratio is anticipated on your behalf, on your part. And you think that everything goes as per plan, and then you feel that this is a sure thing, and I can borrow against this. The returns are very good. I can fund this 50-50 with borrowed money, and I can borrow money at 12% per annum. And this is the mechanics of how this works. You can do the step-by-step calculation. If you do that, you make a 46 point, unlevered 46.41. Your total return is 10%. Your annualized return is 46.41%. With leverage, your return on equity comes to 17% after interest. Very good return. Now let's change the scenario too. Suppose the investor was wrong in assuming that LIC will not tender. LIC ended up tendering all the shares. Now the number of shares tendered is far more than the offer size. Acceptance ratio will be 20 on 39, which is 51%. Assuming the remaining 49% of the shares that are returned can only be sold at 80 bucks because the market stock price will crash, the shares will come back, all the arbitrages will dump. They may well go below the price that was prevailing before the offer started. So what will happen in that case? You will end up with a minus 66.82% loss, and you will end up with minus 51% of your equity gone. Because you didn't think about the possibility the LIC could tender their shares. If LIC tenders, this is what will happen. If LIC does not tender, this is what will happen. You didn't think about one of these two things will happen, right? What if the investor says, "ये दोनों में से कुछ भी हो सकता है." Let me put probabilities. Let me think that I put a probability of 25% chance the LIC will tender and 75% chance it will not tender. When you factor in even a small chance, 1/4, the deal becomes not worth doing. You can only make 6%. Do you think if you factor this in, do you think this deal, you should walk away from this transaction? And notice, you're only thinking 25, make the 25 into 10, this 6% will drop. Sorry, 25 has to be jacked up. If the 25% tender, the higher the probability the LIC tenders, the lower the returns will be. Because the number of shares that will come back will be so much higher and they will all go at a loss. Only the number of shares that will be accepted, which will go at a profit, will go down. And the number of shares that will be returned to you will go up, which will all go at a loss. Therefore, obviously, your returns will go down. You can do the math, basically. And I did that very simplified format. And this is a situation where it's 6%. You can easily visualize a situation that if you go wrong in your thinking about how LIC will behave on that day, and you may have looked at past 7 transactions where LIC did not tender and you went and put all your money in thinking this is what you're going to get. This is how overconfidence happens. On this 8th deal, LIC tenders. One thing which you learn about probability is that things that have never happened are happening every day. So to imagine that this has never happened before, therefore it will not happen ever, is a very faulty thinking from a probabilistic point of view. You have to imagine the worst case scenarios. You have to incorporate remote loss scenarios and the consequences of what will happen if that scenario arose. And if the consequences are unacceptable to you, then the probabilities really do not matter. If you put a gun on my head, which has 1,000 chambers in it, and you tell me I'm going to pay you, 10 crore rupees to pull it once, and only one of the chambers has got a bullet in it, I may have pulled it when I was very poor, smart, and a deep desire to become very rich. But at the age at which I am and the financial position at which I am, I'm not going to pull it. The upside is not, the downside risk is not acceptable to me. And I think that will be the same case with a lot of you in the room. When the downside, the probability of the bullet being in the chamber when I pull the trigger is 1 on 1,000. That means 999 out of 1,000, I'm going to make the 10 crores. 1 out of 1,000, I'm not going to make the 10 crores. I'm going to be on the floor. And therefore, you're thinking about probabilities. People start thinking, oh yaar, बहुत अच्छा chance है, इसमें तो हार ही नहीं सकते हैं. But they don't think of the consequences of the probabilities not favoring you. If the consequences are of a very remote possibility are unacceptable to you, whether it is money or reputation or health or whatever it is, then you should just walk away. You don't even look at the expected return. You don't even do not look at the upside if the downside is unacceptable. That's such an important thing to think about. And you can play around with the numbers. I'm just trying to sort of internalize this with mathematics embedded in this, which is what you sort of learn from this thing about life, about investing, that it made sense at one point, it doesn't make sense at this price, and you thought LIC will not tender. If it tenders, then all hell will come on you. So now my question is, why did I leave that field? One thing that I realized was that the spreads are very small. You're tendering at 80, you're buying at 60, $20 ke piche. You're effectively picking up pennies in front of a steamroller. So it's a metaphor that there are these pennies lying, these are small pennies, and the steamroller is coming behind, you're not seeing it. There's a cap on the max you can make, but in straight equity investing, you can make a lot of money. The upside is 20x, 30x, 40x. In fact, I've had the misfortune of making a lot of superb IRRs in some of the transactions that I've done, which I had not done. I just hold on to those shares today. I would be a much, much more wealthy person today. Because after I tendered them, after I did the buyback, after I did all those things and all that, if I had not tendered, if I had not done, I just sat on those shares, today they will be, some of them would have been like 400x the price that I paid for them. One of them is a company called Trent. At one time, I bought 1.5% of Trent. You can do the math. You can do the math. I sold it when it became 2x. I bought it at $60. It was just listed. It was selling below cash, 2001. It had just listed. It was Lakshmi got sold to Unilever, and the money came into Lakshmi. Lakshmi was renamed as Trent, and Simone Tata decided to go into organized retail, and the stock was selling below cash. I paid $60. I sold out of 120, 130, 1.5% of the company. I don't know what the market cap is. Don't tell me. The second reason I moved out is competition, obviously, because the kind of things that you all agree that I've shown you, the kind of insanities, the kind of inefficiencies, and the kind of stupidities that were available to be exploited, whether it was UGS 10,000 or SBI Mutual, whether it was inefficiency in the market or in the structure of the products that are being offered, those are either massively reduced. I mean, there are new ways of stupidities, thankfully, which are being invented, and that will continue. And hopefully, we'll find ways of exploiting them. But those old ways of doing stupid things are no longer there. So, and I could see competition coming in, the spreads narrowing. And I also found that competition was actually becoming unhealthy, to the point where I found that I was actually becoming a patsy in the game. And here I want to talk about a personal experience where I lost my shirt. Case Castrol India open offer. March 2000. BP Amoco, a British company, acquires Burma Castrol PLC, a UK parent of Castrol India, and because of indirect control, they have to make a tender offer to Castrol India's shareholders. BP seeks exemption. They say, no, it's an indirect offer. We never thought that we'll have to make this tender offer. We are MNC, we are, SEBI says, it doesn't work in India. You have to comply with Indian laws. You have to make the tender offer. And therefore, there was an offer. People calculated the 6-month average price. You can calculate likely price at which the offer will come. The price in the market is below the offer price. It's Castrol. So you do the calculation, you buy the stock. BP offered 311 per share for 20% of Castrol. They calculated they thought that the price should be 311. SEBI objected, saying price is too low. You should have took the wrong date, because you see, you take 6-month average before the offer, and they took a long time to make the offer. In between, the price has gone up, so it will be calculated in the calculation of the offer price. The very act of arbitrageurs taking the price up became a factor in calculating the price that they would be paid, because they took a long time in deciding. SEBI said you should pay 350, not 311. and you should pay interest. You are not done the offer, you're delayed. You pay interest, and pay interest 15% delay. They went to SAT. They went to High Court. Then they went to this. They went to that. Ultimately, they ended up paying. Long story short, I just tell you what happened. Ultimately, again twists and turns. They fought all the way to the court. They ended up paying $417, including interest. By 2021, they had to increase. SEBI put his foot down, argued wonderfully, and they lost the case. They had to pay. But I was sitting in my room and the TV was on and I'm watching CNBC. And in one of the situations, the company said that SEBI has said that they are going to, had told them to pay this and the interest. And they very quickly calculated how much will be the price. And then CNBC announced that they have spoken to the company and the company has said that they will honor SEBI's directive. And I'm looking at the screen because CNBC hai, and the market is open and the stock has not moved. And I'm looking at my funds and I have a LAS facility with the banks. In my name, my wife's name, everybody's. So I went and borrowed money. Lock, stock, barrel. And I said, sab laga do. I sold shares. I put that money. I borrowed money. I put the money based on what the TV was saying. Next morning, the company said, "You're going to court. We don't agree with SEBI." The stock tanked. Now I have a levered position in my portfolio. I have not seen CNBC after that, except during when I go to meet my mother or when I go to the barber and I see the barber, I say, TV band kar do please. मेरे को allergy हो गया है. Who's going to be taken apart by the other players? And as the saying goes, if you don't know who the patsy is, you are the patsy. So I found that not only the competition was there was many cases I found that the price has moved adversely. And I'm buying the stock, I say spread to wide ho gaya, kharid leta hu. And then finally find out the announcement about a very adverse development came later. There was insider activity going on and I was on patsy in the game. Basically, I was on the wrong side of the trade multiple times and I said, buddy, time to go home. This is a business, you have to close this thing. At least not for me. I can't do this. The other thing which I found was the IRRs that I showed you, they look very lovely and they look very beautiful, but they expose you to what is called a reinvestment risk. The money goes out for 3 months, IRR is wonderful, and then the money is lying in FD. And if you do the math over the long term, the overall returns may be good, but they're nowhere compared to the kind of returns would be if you just sat on your ass in a good company and just compounded in a country like India. So I had the realization. To give an example, if you had, to give you an example, we looked at the LIC situation. Scenario 1, 75% probability. Scenario 2, 25% probability, tender or not tender. On this transaction, I will not make the average. We calculate the average. Supposing I was very smart, had done the calculation, 6% I walked away. But imagine, for the sake of argument, that the 6 was actually 12, 13 or some number. So numbers look very good. So in this transaction, I'll either end up with scenario 1, which will give me a big profit, or I'll end up with scenario 2, which will give me a huge loss. I'm not going to make the average. It will be binary. On that trade, on that night, on that morning, when I wake up, I will know whether I will have a huge profit or a massive loss. The average, it makes sense. And if I do a few dozens of them, it will even out. How will be night? How will be my night? वो क्या करेगा सुबह? Well, it's almost like when I was a teenager. Will she, won't she? It all boils down to how other people are going to behave towards you. It's not about the business, it's about the people. And then I started realizing that the opportunity cost of this is very high, the twists and the turns and the gut churns. And I'm not even told you about, I have not talked to you about certain transactions. I've gone through hostile takeovers, I've gone through crazy things I've done in buying stocks and shorting them and trying to hoping that this transaction will go through, praying to God कि please ये कल कर देना. और उस रात को जो हाल होता है one night before, I don't want that. I don't want that anymore. I don't want to go into the prayer mode because it looks very nice on expected return tables, but when you know it's binary, then you start thinking, यार ये मैं क्यों कर रहा हूँ? Especially when you think that I could have not done this at all. I could have just been in this one thing and done so much. I would have been so much better off. Jitin, we are off time, huh? That's okay, right? I am on slide 48 of 124. And then I slowly realized that I don't have to give it up. I can give up the practice, but I can incorporate the learnings, which is what this title of this talk is about. So I've just finished the warm-up session. Now we move into the actual content. So I found the key ideas of risk arbitrage in conventional investing offer huge advantages which are not there. One of them is obviously you don't have to be trigger happy. You don't have to worry about कल क्या होगा, एक घंटे में क्या होगा, वो decision आने वाला है. Reverse book build होगा कि नहीं होगा. How many shares will be tendered? Will they say yes or no? Will the offer succeed or not succeed? Will the judge say deal okay or not okay? So your focus shifts. Secondly, you're not picking up pennies. The upside, if you can incorporate these ideas and apply them, which I will show you, which the way I'm thinking about them right now, then the upside could be so much big in terms of gains on the upside. So you're not picking up pennies anymore. It frees up time because you don't have to constantly monitor transactions and all that. The opportunity cost part of it. You can spend time doing other things that you really enjoy, meaningful things in your life, and that becomes more important to you as you grow older, which is what has happened to me. You make money while you sleep instead of having sleepless nights. As Buffett has said, if you can't figure out a way how to make money while you sleep, you will keep working hard until you die. So if you buy into great businesses who are going to keep compounding wealth over a long period of time, you're making money while you sleep. Money works for you instead of you working for money. So that's like, that part of low stress investing. And then it's a fairer game. You're not patsy in the game. You are actually not on the wrong side of the trade of people who are like day traders who lost these tens of thousands of crores. This is one company which has made some 36,000 crores, whatever the profits that they have made. We're talking about this case that is going on against this high frequency trading company. And the competition is low because, again, you're moving into a space where there are these biases that exist, where for some reason or the other, people overreact to certain situation, adverse development, and we can use the same framework to exploit those inefficiencies. And obviously, being a lifelong reader of Warren Buffett and Charlie Munger has really helped me. And they have written about the importance of learning probability. Important one, was invented by letters. You should read those letters. By the way, Fermat Pascal letters. They invented the theory of probability by writing letters to each other. They are available on the net. Just to Fermat Pascal letters. And he said that you have to have the technique, and that's what he means. I think that is what he means when he says that you have to have the technique. Once you understand the mechanics of it, then you start incorporating. You don't have to actually go down to the calculation the way you were doing in school, but the intuition behind it is more important than the actual mathematical calculations. And then I came across this wonderful quotation from Warren Buffett, which was like a eureka moment for me, because I said, this is wonderful because this can be applied. And went around looking for Buffett letters and Buffett talks on how he has incorporated, I think, his ideas, what he learned from practicing risk arbitrage in conventional investing. And the eureka moment was this one, from this quote. A great investment opportunity occurs when a marvelous business encounters a one-time huge but solvable problem, as was the case many years back at both American Express and Geico. So obviously, you go and once you read something like this, you want to go and research American Express, kya hua tha? You want to research Geico, kya hua tha? So I won't do both, and there was a third one which I will cover, but I won't cover all three. I'll cover just two of them. So I'll go fairly quickly because a lot of you are very familiar with this thing, and also we are running short of time. Is there a hard stop? Okay, good. AM or PM? Because I have a reputation, of mixing up the two things. So in 1960s, Buffett is a young investment manager. He goes and puts 40% of his money in a company called American Express, and the company is involved in a salad oil scam. It has a subsidiary which is into a warehouse business, and why it got into the warehouse business, don't even ask. And there's this scamster, Antonio DeAngelis. He takes up a lot of these tankers, fills them with seawater, drives them into a Amex warehouse company's facilities, and he says, I want you to store these for me. This is salad oil. He tells them it's very precious salad oil. It's actually seawater, and nobody bothers to check what's inside. So the Amex people, they give him a receipt, warehouse receipt. If you are familiar with what happened with NSEL scam, you know what happened to those receipts. He gives that receipts, and that we certify that we have in possession so much tons of salad oil of this variety of this gentleman, anybody on American Express letterhead. This guy takes that document, goes to a bank. He says, this is collateral, I endorse it to you, give me a loan. Bank doesn't bother to go and check, Amex ka naam hai to theek hai. So takes a loan, big loan, $150 million loan, not a small sum of money in 1960, $150 million loan, and goes to the casino and blows up the money. Now there is a problem. Scandal is unfolded, it's all in the media, and there is shit has hit the ceiling, and Amex stock is tanked. And now Buffett is looking at the situation. So basically, $150 million is a lot of money, but Amex is a different company, the limited liability concept, and Amex can walk away because, subsidiary ki problem hai, why should I get involved? But Amex being Amex, moral as, obligations are different from legal obligations. They say, no, we will honor it. We will pay the bank. But if they pay the bank, there's a fear that they will be run on American Express. And the run will be on traveler's checks. Amex is in the business of issuing traveler's checks at the time, which are basically pieces of paper which people have been given in exchange of actual dollars that have been deposited with American Express. Traveler's checks was a very useful product at the time because people were very scared of traveling with cash in their pocket, so they would carry traveler's checks, and Amex branches are all over the world. So they would go and give cash and take traveler's checks, and then go to any American Express branch and give their ID, and then give the traveler's checks and get the dollars out. Effectively, this was a float, interest-free money that Amex had in its possession. And the street was believing that they will be run on Amex because they don't have the money on the other side of the balance sheet. They're illiquid. They have securities worth 500. They have $526 million. Ye sab nikal jayega. They have cash of only so much. Basically, the whole tijori will become almost khali if there is a run. So Buffett said, well, let me look at this. So he called up a few friends. He goes and he looks at the situation, he finds out from his friend that nobody is bothered. Amex checks are being accepted by merchants. Amex and people are not rushing to encash their checks around the US. So he comes to the conclusion. Notice what is happening. He's thinking of the worst case scenario. He's thinking of the probability and the worst case scenario. Probability is that it's almost impossible for there to be a run in the bank. But even if there's a run in the bank, they still have the money to pay. It's not like Amex will go broke. The core business will survive. It's not that you're going to go broke. And that's very important for us to understand and incorporate. That when you're looking at these situations, you're going to find situations that you will get hurt, but you will not die. If you can get hurt, even meaningfully hurt, and if you will not die, and you will survive to live another day, but the market believes that you're going to die, that's an inefficiency, right? So we'll use that going forward, but park that thought in your head for the time being. We'll come back to that. So he looks at the situation, he looks at the market prices which have collapsed, he goes and buys the stock, and he turns his 13 million into 33 million, which was one of the worst mistakes he made, similar to what I did in Trent. He sold for 33 million, he would have made a few billions if he had not sold it. See, he made 3x and all that in the whatever he did, but effectively he could have made a lot more if he had not sold it. Amex, this American Express became a wonderful business. So this is the thinking about the case, okay? And he said, look, this is not bank debt. If it was bank debt, it would have been recalled immediately. These are travelers' checks spread out all over the world. These are diffused, liabilities. People holding it, they don't even care. Amex is very good. He got it checked out. He went to stores and he looked at. He called up his friends and he found out that people are not really bothered. The merchants don't care, and the people who are holding American Express checks don't care. So the fear in the Wall Street was not translating into the fear in Main Street, and that was his due diligence. And he bet with that, and he went and put up 40% of his. Notice again his position sizing. He put 40% of his partnership's money in a situation where he felt that there was virtually zero chance of losing money in that particular situation. Right or wrong, we don't know. We know that we wouldn't have heard about the guy if he had done well in that trade. It was it's a big deal for him at the time. Fast forward many years, decades later, he goes and makes an investment in a company called Wells Fargo, large bank, which is in trouble right now. They have been out of it for the longest time, for a while now, but they made spectacular amount of money in Wells Fargo. Now, this is important for us to understand because we'll apply this idea in a current context in India right now. I won't take names. I just wanted to incorporate some of the ideas that Buffett used when he analyzed Wells Fargo. So he's looking at 1990 at Wells Fargo. There's a chaotic market. Bank stocks are down, and there have been some foolish loan decisions, and there are huge losses that are coming in those banks. And investors are now there's a flight away. Suddenly banking stocks are out of favor, and he goes and buys 10% at $290 million. Less than 5 times after-tax earnings and 3.5 times pre-tax earnings. He paid 3 times or 4 times pre-tax earnings to buy a 10% stake in Wells Fargo. And then he writes that I could have put, they have $56 billion in assets. They are earning 20% on equity, 1.25% on assets. He said my $290 million for a 10% stake is equivalent to buying a $5 billion bank at half the market price. A smaller bank would tragically. He's making the comparison that if it was a business, a full bank, what would I pay? Business versus stock. He's making all those comparisons. And then he said, well, it's run by this guy who's like one of the best bankers out there. I'm getting this also at 3 times earnings. I'm getting the best. It's like getting Aditya Puri at like 4 times earnings for HDFC Bank. So that's the point that he's making here. He's saying that, well, I know that there is a risk here. Now let's look at the downside. He then talks about the upside. Now look at the downside. It's a California bank. California is prone to earthquake risk. Then there's a systemic risk. If fear spreads, then people come and withdraw money from banks. There's an asset liability mismatch. They all have short-term debt and short-term liabilities and long-term assets. If there's a systemic risk, all this could happen. This could happen. These are not something which are impossible. It's far from riskless. But he says because it's the leading real estate lender, Wells Fargo is particularly vulnerable. He says, I get that. It's a California bank. It's like investing in a local bank. It's not like a diversified bank with branches all over the country and assets all over the country and a deposit franchise all over the country. Then he goes into probabilities. He says, while some eventualities cannot be ruled out, the probability of major real estate value drops causing significant issues for well-managed institutions like Wells Fargo is low. He's not putting the numbers to it, but he's using the intuition. He's doing the same thinking, that the probability is low. He says, look at, they're earning $1 billion pre-tax annually, even after expensing $3 million for loan losses. That's what they've been doing over the last few years. They make 1.3 billion, 300 million goes in loan losses provisioning, and still they make 1 billion pre-tax. Then he makes a calculation of what he thinks the worst case scenario. This is very important. Again, you can use this or some other method or whatever you do. He does the stress test. He said even if 10% of all his $48 billion in loans, assets, whatever the loans are, faced problems in 1991, resulting in average loss of 30% of principal, the company would still roughly break even. And he says this is the remote loss scenario. He says the worst thing that will happen to this bank is that there will be an year in which it will not make any money. He said, I would love to invest in a situation like this, which will not make money any year, but will continue to make money at 20% on growing equity thereafter. He said that possibility is low level. These are his words. We viewed a potential challenging year as a low level possibility, not a likelihood, and therefore it did not cause distress. Panic is good. This is very important. Despite having purchased shares before the fall, we welcomed the decline as it allowed us to acquire many new shares in the new panic. So notice, he's not approaching it as an arbitrage. There is no tender offer here. He has already bought the stock because he loves the business, the management and everything. Now this has happened. He's now looking at it. What is the downside? What is the worst that can happen? What are the chances of it happening? And notice the shift. I'll come to that in a minute. I'll come to that after a while. Actually, there's a quiz coming for you. You all have to answer because you cannot leave the room unless you answer the quiz correctly. That's what happens when you call a professor in the room. He's looking at it exactly the same way you look at other opportunities that we looked at. It's no different from Arcata or, the other situations that we looked at. What is the upside? What is the downside? What are the probabilities? And time. Time is no longer 3 months. Time is years. Just keep buying. He goes on to say, I'm a perpetual buyer of investors, and people go mad when some negative development happens. Paradoxically, the conclusion that I'm going to come to eventually, which will be something that I'm going to talk to you about, if you understand the point that I'm making here, the best thing that can happen to you if you have money, that some of the companies that you have in your portfolio, which are very good companies, assuming that they go through a terrible period. They experience this. Imagine if HDFC Bank has a loss. What will happen to the stock? One time, एक साल में कुछ गड़बड़ हो गया. You will get it at 4 times earnings, depressed earnings. That one-time opportunity that you get. Imagine if Kotak goes through a major loss. Imagine if Shriram Finance goes through a major loss. I'm not going to name names. Basically, I'm talking about very highly respected lenders will also have pain periods. We are now turning ourselves into sadists. We want bad things to happen to good companies. Not because we like bad things to happen to good companies, but we like the prices that they produce. And this is what Buffett has written over the years. This is actually written on my wall. He wrote, actually comes later. Fear is a foe of the faddist, but a friend of the fundamentalist. So, expose the businesses to stress tests during pain periods. Think of worst case scenarios. Notice that they don't operate in a vacuum. Again, this is very important because businesses don't operate in a vacuum. There are 10 other competitors out there. If remind you of sports, if you go to a sporting event and you come back minorly hurt and everybody else has broken their legs and they can't walk anymore, you've done pretty well. The same logic applies in the world of business as well. If an industry is going through a downturn, a terrible downturn, and everybody else is basically dead, and you have also fallen on the ground, but you can get up and dust off, the thing and walk out, not meaningfully hurt, you're the last man standing. You will come back. It will take years maybe, but the market will be punishing to the stock when you fall down. And that will give a chance to us to buy into that business, that one-time opportunity that you will get. That internalization comes when you think about it from that point of view, the expected return point of view, that the downside is already in the price. The worst case scenario is already incorporated in the price. It's fallen so much already. What more can happen from here? And again, just because it has dropped 80% doesn't mean it can't fall anymore. I mean, people made mistakes in that in Yes Bank, for example. So you can't get into the anchoring bias, it's dropped 60%, it's dropped 40%. It has to be anchored to some reference point, to some numbers or financial numbers. What is the average PE multiple? What the business is likely to make after the injury, after the comeback? What are they likely to make when they recover? In relation to what am I paying right now? And market is not factoring that they will bounce back. Supposing a company which has got a large customer concentration risk, but has very high margins, has 4 customers, loses a very large customer, 30% of the customer, and as a consequence of the stock drops. Yes, it's bad. It's also wonderful because the company will survive, because it's a high margin business. You can lose a customer, you can come back, you will live to fight another day. But the stock will drop 40%, 50%. At that price, when you look at that market cap, then you will compare what the normalized earnings will be when they bounce back 2-3 years down the road. What are you paying for the normalized earnings when they bounce back? If they bounce back, probability of bouncing back, when will they bounce back? That is all incorporated in this kind of thinking. So this is what you want things to happen, that these companies go through that pain periods. Now some examples of my own journey. I'm now halfway done. So that AM PM thoda sa dekh lena. This is something Anuj is here with me. Anuj is we have worked together for many years, and he's in the room, and he and I have worked on many of these things. From here onwards, he's entered the room. So now, if I have make any mistake from here onwards, please ask him. Canfin Homes, a company in which we have been invested for a very long period of time. Again, a spectacular long-term track record of underwriting discipline in home loan. Very simple, easy to understand business. May 2000. I'm not going to go into why I own this business. I like the business. We have owned it. Lovely thing. All is good. May 2022. Based on a complaint received by NHB, audit committee of the company requested Canara Bank to conduct. Canara Bank is the holding company of Canfin Homes. So there's a fraud intimation. There's a fraud. And notice whenever a company says एक fraud हो गया, तो stock market में क्या होता है? Fraud हो गया. Okay, ठीक है. Stock collapses. Fine, that has happened. Fraud accounts at 3.93 crore. The company's net worth is 3,000 crores. So 0.13% of this thing. But we also all remember that there is never just one cockroach in the kitchen. So what if there are more cockroaches? We stopped buying. We were buying the stock. तो अभी हमको पता नहीं कॉकरोच और निकलेगा या नहीं निकलेगा. अभी तो बंद कर दो. ठीक है? Stop buying, right? Then watch what happens. And the stock is dropped. Stock has dropped quite a bit, right? Auditors as well as NHB, National Housing Bank, which is a regulator of home lending businesses, home loan companies, they said it was the one-off, not thing. The company also implemented remedial measure. Incidentally, these are all documentation fraud. The fellow was doing KYC fraud somewhere in Ludhiana, or I think Ludhiana, or some Patiala, Ambala. So and they did not lose any money on this. There was no loss, but they had to classify it as a fraud and a massive overreaction. Again, we waited for this to happen. It's come, but the stock did not go back up immediately from where it had fallen. And then between the company continues to perform, whatever it has been doing, that is continuing. September 22, MD resigns, but stock tanked. But he joined to buy to another company. He resigned not because there's problem in the company, but there is this jumping to conclusions. एक 6 महीने पहले fraud हुआ था, अब ये भी निकल गया, बेचो. So this is what we love. It's like this guy is not Shah Rukh Khan. This is not a company which is dependent on a single personality. He's not like a rock star. He's not an iconic fellow. Yes, he built this business. Yes, he's a contributory factor. He went up. Yesterday, he resigned from PNB also. We found out. He just moved on from PNB. Anuj sent me the thing that we only talking about yesterday. And now he's gone to PNB Housing also. So yeah, these personalities come and they go. But if you look at the long-term history of this company, the company was doing well before he arrived. The company did well while he was there. The company has done well after he has gone. So what was his role? Not zero, but I don't think it was the main thing. But markets think that he's the Aditya Puri. By the way, even Aditya Puri's departure has not really made a big difference. And if you think about it, the largest growth in the market cap of Apple came after Steve Jobs died. The guy who was behind it. It was a one-man company, remember? The guy. He died.
Same for Suzlon.
Suzlon is in a different. We will talk differently. I have done cases on Suzlon. I went and met the company many years ago because I wanted to short their stock. I got onto their investor list. They keep on sending me presentations for years and years and years. So you came to us, you met us and all. But I shorted the stock after I bought them. I met them. And I was cleaned out of that. That's why it stopped me from shorting, because after I shorted them at 35,000 crore market cap, they went to 45,000 crore market cap. Anyway, that's very old story, so I don't want to get into that. 2022. 2023, एक और fraud हो गया. I'll tell you one thing. If you have run banks, I have audited banks. I'm a chartered accountant. The absence of fraud is actually more suspicious. Why do people rob banks? Because that's where the money is. Famous quote. It's so tempting. The employees, they will take the cash. The bankers, they will give loans to their cronies. There is always some fraud, some shit or the other is always. This company is actually saying, chota mota fraud bhi report kar do yaar. So a lot of frauds are not even reported. You're looking at something that is reported and you're going out, oh my God, there's a fraud. Frauds are a feature, not a bug in the banking industry. They're a feature. People don't realize that. It should not be huge. It should not be like what happened in Yes Bank. It should not be what happened with many other, we don't have to name names here. We don't want those kind of situations. But people have that experience and they take this and they say, oh, this is the same as that. So, yeah. So, Canfin, this is what Anuj sent me a while back. I've used it. By the way, a few days ago, he only sent me this. The most respected value investor in the country, Mr. Prashant Jain, his fund bought recently up to 4.26% of Canfin Homes. He bought it. This is actually 2024. We are actually farther than that. The point being that there are these multiple points. There are these three things. You go back to the point. There's a book which I love. I don't love the book's content. I love the title. The title of the book is Just Keep Buying. Ignore the noise. Ignore the noise. Do the math. Do the calculation. Do the thinking. Reflect. How serious is this? Is this serious? इतना गिर गया? What is the magnitude of the problem? Sometimes khoda pahad nikla chua. This is what is happening. Yes, there's a problem, but look at the reaction of the market to the problem. That's the special situation framework. That it has dropped so much in relation to fundamentals, normalized earnings, it's become cheap. It has never been this cheap in the last 10, 15, 20 years. This is the only chance you're going to get in the next 10, 20 years to buy at this valuation. This problem will go away. It's just taking all the attention. People are focusing on this one thing. It's not a material thing. It's a feature, not a bug. It will go away. This problem will get solved. And the main business, core business will continue. It's not a devastating event. It's not going to destroy the company. Balkrishna Industries. It's a case study in my case studies program. 2014 till date, IRR is more than 26%. To 2019, the stock dropped 48%. There were some headlines about this company and this industry, generally speaking. And there was this guy who was basically making a lot of noise and, around the world about मैं ये कर दूंगा, मैं वो कर दूंगा. And as a consequence, people got scared about this guy. And as a consequence of that, the stock dropped 48%. What was the name of the guy? Donald Trump. He was in his first term. He was not using the word tariffs. He was using the word trade wars. All the stories are trade wars. All the exporters were thrown out. PKT being one of them. And it was available to us at we had already owned the stock and it became available to us at a very, very cheap valuation. And, oh, sorry, should be here. So again, it happens. Trade wars, what do they mean? Tariffs, what do they mean? If tariffs are imposed on every single country, every single competitors of yours, it's like, even if it hurts you a little bit, you're the lowest cost producer in the world. How does it hurt you? And here, there's not the only country into which you export. You have 25, 30 other countries to which you export. People don't think like that. People don't look at the magnitude of the problem. What is the worst case scenario? And how much will this hurt the other competitors? In that sense, bad news becomes good news, because unlike in a casino, when you go, put your money on a number on a casino, no matter how many other players come on the table, the odds of your winning or losing don't change. They're exactly the same. You're betting against a casino. That's a normal casino game. In a pari-mutuel game, the odds change based on the behavior of other people. And this applies to the world of industry, this applies to the world of markets. In the stock markets, if the stock comes down, it becomes a better purchase than before if it comes down for the wrong reasons. The behavior of other people have made it an even more compelling opportunity than it was before. Fear is a foe of the faddist, but a friend of the fundamentalist. 2022, I did a case study, a detailed case study. I have just finished it again, a follow-up case study on a company called IRFC. This is in Flame University. And this stock was listed in 21, was selling at 24, 23, 22, 20, 24 bucks. Below book value, very high dividend yield. It came on our screen as one of those, high dividend yield, very high, growth in earnings and so on and so forth. What does it do? This again from the note that I prepared in 22 when I did that talk in Flame. It's a dedicated funding arm of Indian Railways. It finances the rolling stock. Basically, all the rolling stock of Indian Railways, a lot of it, they would, Railways will not buy it. They will ask IRFC to borrow money from the markets, bond markets, and use that borrowed money to buy the rolling stock and then lease it to the Indian Railways at an IRR which is just only slightly higher than the cost of debt that they're borrowing it from. So it's like an investment banker. It is an investment banker to the Indian Railways, right? So, it got listed in 21 and 22. We are looking at the stock. 21, 22, a few months after it's listed, we're looking at the stock. Stocks come down. It's not going anywhere. And we find the model very interesting for many reasons, like mind-blowing. One, there are no bad debts in this company. This company is designed to never have any bad debts. It's a lending business with no bad debts and can never have any bad debts because it's sovereign. Okay, so it's lending money to the government. Number two, another one. It has no sales department. Obviously, you 49, and it's not a small little company. We're talking 22. They have $49 billion of assets under management in March 21, and they're 29 employees. No branches, operating out of Ashoka Hotel. 29 employees, $49 billion of assets under management. Stock selling at 5 or 6 times earnings, 5% dividend yield, well below book value, AAA rating in the bond markets, and it has no asset liability mismatch. The kind of things that happen in lending businesses, the things that take them down is asset liability mismatch. That's how Lehman Brothers died. That's how long-term management died. That's how Yes Bank almost died. You have short-term liabilities which are coming due for repayment, and you assume that you can refinance it. So you don't have to sell assets to pay off the debts that are coming due. You raise more debts to retire old debts. So everything is happening on the liability side. So basically, you're robbing Peter to pay Paul. Not exactly robbing, but you get the point here. So everything is happening on the liability side. You don't have to liquidate anything on the asset side. So assets can then be deployed in higher yielding long-term assets, which are illiquid. And the assumption is that you will be able to liquidate. You will never be required to liquidate them to refinance your liability. It's like credit is like oxygen. Beautiful quotation from Warren Buffett. Companies with large debts often assume that these obligations can be refinanced as they mature. That assumption is usually valid. Occasionally, though, either because of company-specific problems or a worldwide shortage of credit, maturities must actually be met by payment. For that, only cash will do the job. Borrowers then learn that credit is like oxygen. When either is abundant, the presence goes unnoticed. When either is missing, that's all that is noticed. They choke to death in a matter of hours because financial markets shut their doors on them. We are going to refinance, and there are $10-20 billion of debt that is coming up. That's how Lehman Brothers collapsed. And there are case after case after case after case you can look at. So it's a very standard cause of death in levered financial businesses. And therefore, if you're studying a business model in that space, you have to study that risk. Well, in this case, not only they have match durations, they have a clause in every lease agreement with the government that in the event we run out of money to pay an upcoming liability and we are unable to refinance it, railways will put in the money well before time. This clause is there in every lease agreement with the government, with the Indian Railways. It has never been invoked in the last 33 years, but it's there. What about project risks? People have blown up in infrastructure investing. There was in 2007-8, there was a whole infrastructure bubble which burst. A lot of funds blew up. A lot of banks blew up. Again, that risk doesn't touch this company. Everything is cost plus. You have time overrun, pass it on. You have cost overrun, pass it on. You have borrowed money in foreign currency, and exchange has moved, rate has moved unfavorably, not fully covered by hedge, and cost has gone up, pass it on. They just get paid based on their cost. Everything is on the government, right? What does CRISIL say? All this is there, at the time when we actually there in an investment note which you wrote about when we invested in it. CRISIL says, oh, it's AAA. It deserves AAA. This company pays no income tax. It pays no GST. It is exempt from income tax. It is exempt from GST. and it's massively overcapitalized. When you look at capitalization of companies and banks, you look at capital adequacy ratios. At the time, HDFC Bank had a capital adequacy ratio of 19%, Kotak had a capital adequacy ratio of 22%, ICICI 19, Bajaj Finance was 28, Manappuram was 29, Shriram City Union was 28, Muthoot was 27, Shriram Transport Finance was 22. IRFC's capital adequacy ratio on 31st March 2021 was 416%. Why is that? Because the risk weightage of lending money to the government is 0. Which means this company can be run with no equity. And I had it checked out with one of my students who was in the class. I said, would you lend money to this company? She said, I would lend it in a heartbeat. It's AAA. Bonds, basically, bond market investor. So the debt equity ratio doesn't matter in this company. The capital adequacy ratio is 416. And that's important because we'll come to that in a minute. So we talked about this. So it's hugely profitable and the earnings have grown and grown. This is before the IPO. What does it make? It makes only 40 basis points and 35 basis points depending upon the stream of earnings or cost. We don't have to go into that in detail. But look at the assets under management have grown, interest income. Look at the pre-tax earnings. Post-tax and pre-tax are the same in this. From 442 crores in FY10, this is rupees million, the earnings have grown to 4,416 crores in FY21. So there are 10x growth in earnings in about 10-11 years. CAGR returns are here. So, and why is that happening? We know why that is happening. Infrastructure push, modernization of India's railways. Somebody has to finance it. IRSC played a huge role in that. This is all before the IPO. So assets have grown, 5-year AUM growth, all this is lovely. Growth in earnings, all this is lovely. Now here is the most stunning thing about this business that I'm going to tell you. I mean, as if the other things were not stunning, the most stunning part is coming now. Which is that while the post-tax earnings grew from 442 crores to 4,416 crores, the EPS of the company was 4.06 in FY10, EPS of the company in FY21 before the IPO is 3.38. What the hell is going on here? Answer is obvious. They had 1 billion shares outstanding before the at FY10. Before the FY21, that raises to 13 billion shares. What the hell is going on? So I'll tell you what is going on. They had this mental model that we have to maintain the debt equity ratio is to 90:10. No matter what the bond market says, no matter what the capital adequacy ratio says, no law says that you have to maintain it to 10:1 max debt to equity ratio. And with the asset book growing so rapidly, they had to continuously increase the equity of the company. And some bureaucrat in some ministry decides that all the new equity in the company, which was to be given by Government of India, President of India, will be issued at $10. I don't care what the book value is. And doesn't matter, there's no dilution risk here because all 100% of the company is owned by the President of India. So prior to the IPO, all issuances of shares happening at $10. Obviously, if you keep issuing shares at $10 per share, every year there's a share issuance and the number of share count has gone from 1 billion to 13 billion and the earnings have gone up 10x, but the share count has gone up 13x. Obviously, the EPS is going to go down. Market is looking at this. So growth in EPS mein. Historically. Now the question becomes, आगे क्या होगा? आगे क्या होगा? Apply arbitrage framework, special situation framework. Big question. We went through this over days and days and days. Anuj is here. Will the company issue more shares or won't they? Logically, there is no more need to issue more shares for many reasons. One, the 10 is to 1 is a fictional mental thing. Second, this company is not a private company anymore. It's a public listed company. And the government has taken it public for a reason. They want to divest. If they want to continue to issue more shares, they'll have to put more money in this. They have to write more checks. They have sold shares to take this company into the market. Now suddenly they have to write checks. This is not what government wants to do. So I'm now writing to you, telling you about the reasoning as to why we felt that there is very little chance of the government putting more money in this company or the share count to go up. We felt that the almost zero chance of share count going up. But almost zero doesn't mean zero. So you have to think again, you have to think about the consequences of share count going up. Supposing it goes up, so the question then becomes is, fine, they'll continue to do these rights issues. Fine. So the question then becomes, will they do it at $10? अच्छा है करो, और भी अच्छा है. गवर्नमेंट अपना अप्लाई करेगी कि नहीं करेगी? I don't think they will apply. हम उनका भी ले लेंगे. 34 rupees was the book value, I think. 30 rupees plus was the book value. 10 rupees पे आपको इस टाइप का शेयर मिल रहा है. Government is not subscribing to their share, this thing. I can't lose. I mean, how can I lose in something like this? If the share count does not go up, if the trajectory of the earnings that we have seen and the infrastructure push that we are seeing, then what are the consequences? If what you are seeing here continues and this share count stops growing, what will happen to the denominator? Then what will happen to the stock? Has to go up. If the share count keeps going up, it will go up because of the rights issue. The rights issue will be done by the company at $10. We'll subscribe. What if they do it $30-40? देखेंगे क्या होगा तब. Low chance. Our thinking was that very low chance, that there is almost negligible chance that they are going to issue new shares. This is what we wrote. Now, did the prediction come true? Since that day, not a single share has been issued. And as expected, the share count has not gone up. The earnings have gone up. And of course, we know the stock from $21 went to almost $200. It crossed $200, I think. It became a 4 lakh crore company at one point of time. I don't own the stock. I'm not recommending it. None of the things I've told you earlier, I'm talking about, none of these are recommended. I'm just talking about using a framework. Because at the time when we were looking at it, it was a wonderful situation to analyze from a special situation framework point of view. And what we paid for it, this is what we paid for it. Next time when this similar thing happened was when COVID arrived. 2020. COVID is here. Now, no, we all know with the benefit of hindsight that, COVID came to an end. We all lived through it. We have seen people, we lost people, loved ones, and it's very unfortunate, very tragic, all these things happened. But from a high level point of view, if you study pandemics, and of course, being a voracious reader, I love books. Whenever COVID आ गया, तो ठीक अब तो pandemic के किताबें पढ़ना है. So I picked up a few books on pandemics and I learned a few things about pandemics. And I knew a little bit about evolutionary biology, and I put some things together, and I pretty much knew that pandemics will end. They end for all sorts of reasons. We have natural immunity. We have vaccines will come up. Humans are very good at for solving problems, especially when there is an urgent problem. We're pretty good at that. And there's social distancing happening. So this virus is going to die. And unfortunately, some people or a lot of people who have very weak immune systems, they will be eliminated from the gene pool. It will happen, and it happens. It's the way nature works. But it is what it is. We know the pandemics will come to an end. Now the question is, what do we do as an investor? Now, notice we know what has happened post-pandemic. There was a boom, revenge shopping, and people went out, and all that has happened. But at the time when the pandemic was going on, we didn't know what will happen to theme parks, when will they reopen, or what will happen to restaurants, or to the airlines, or to the movie halls. We had no idea. We know that they're all shut, and people are shit scared of, even meeting each other in the house. They're in different rooms, let alone going out and people are working from home, and all that was happening. So at that time it was very difficult, but there was no way of knowing how this will play. We know it will end. We had no idea when. But same with B2B businesses, they were going through a pain period. But there was this one segment of businesses, B2G businesses, business to government. Especially PSU-owned businesses selling to government. Why do I mention that? Because I have friends who are selling to government and they're not very happy people because पैसा निकालना बहुत मुश्किल होता है government से. But if you're a PSU which is owed money by a government entity, you get paid because it's interministerial, government to government. I'm talking about Cochin Shipyard, which became available at 3.5 times earnings. 3 pre-tax earnings at the time. And our thinking was, well, this company is making India's aircraft carrier. It has a very long order book. It is a debt-free company. They have a lot of float on the balance sheet. And yeah, the shipyard may be closed, but that doesn't mean that they will lose business. They're not going to have cancelled orders. A restaurant that is shut down, or an airline that cannot fly, or a theme park that cannot sell seats, or a movie hall that cannot sell tickets, that revenue lost is revenue gone forever. But for a business like Cochin Shipyard, a shipyard closed is only revenue deferred. It's not revenue lost. So I think it is going to come back, no question about it. So our thing, and it has the capacity to suffer. They don't have debt. They have a variable cost structure because they had, they could lay off, they let people go for a while. And they had cash on the balance sheet and their order book was not going away anywhere. And the stock was available at 3.5. And there was this huge defense aspect to it. So that was a factor in our thinking about why we should be in that business. Again, it's the same, the intuition behind the special situation framework, if you can, become good at that, it will become like breathing. It won't be like, oh, I have to calculate this, I have to do this and do that. It becomes natural. It will start coming naturally to you. Rights, railway, play on growth of railway. Again, a consultancy company also into infrastructure projects, turnkey projects. Again, I do a whole case on that. I'm not going to spend time. This one slide I do. Same logic, same thing. B2G, they're not going to suffer. They're going to thrive. In fact, government went out and spent more money to push money into the economy. So that way it was benefited. One interesting thing happened at the time was that when we looked at lending space, one important thing, everything was thrown out of the window, of course, and this whole stock market was down. One thing which we found very intriguing was that are all lending businesses going to suffer? And we felt that there is one kind of lending business which actually should thrive in the environment that we are operating in. And that, of course, is gold lending. So Muthoot Finance was available at $625 per share. And Anuj was primary person behind it. He's actually very bullish on the stock. He sold everything in his house to buy that stock. It's a no-brainer because you see, when the economy is running out of cash, people are losing their job. What do? They need the money. Businesses need the money. They take the jewelry and go and take loans. So the period of COVID was actually good for gold lending business. If you look at the numbers, what was happening. So something that was good was not reflected in the market. The market is actually bringing the price down and the stock is available to you at like the lowest P multiple it has ever seen. And the numbers are getting better and better. And it's a business where you can't lose money. It's some collateralized lending. The collateral is in your possession. The LTVs are very low. And you can sell it very, very quickly. It's an extremely liquid collateral. It's not like you have to take the fellow to NCLT or go to courts and so on and so forth. So, there is no way you can have an NPA or a loan loss in this business. So it was a amazingly, interesting opportunity. I said, we don't know when this COVID will come to an end. We know the business is coming. Stocks become cheap. I don't need to predict when the COVID will come to an end. I know that it's just cheap. It's so simple. And it appears simple. At that time, it was not looking very simple. Now I come to a little longer discussion, the last discussion here, about what I think about an industry that I'm looking at right now. I'm not going to name names. I'm telling you why I'm looking at this industry right now, because it's going through a period of pain. It has been for the last 1.5 years. And I just love this industry for reasons which people don't really appreciate. Microfinance is basically small loans. 10,000, 20,000, 30, 40, 1 lakh, 2 lakh, small loans, right? Typically, the EMIs on these loans are as low as $80, $100, 120, 200, 300 rupees per month, like very small loans. And we all know, a lot of you know about microfinance. But what people don't appreciate is how pro-social this industry is. they're actually displacing loan sharks. While it's true there are some bad apples, it's true that in 2010 there was a massive crisis in Andhra Pradesh and there were farmer suicides and there was an ordinance issued by the government of Andhra Pradesh, and SKS Microfinance was the company which was allegedly behind all that, and it was a whole big scandal that was created and massive regulation came in and all that. That was all seen and observed and commented upon and criticized, and all for good reasons. But what was not visible was the benefits that this industry has provided to society. I want to just talk a little bit about that. Let's take a look at this. This is what is happening in urban India. The sound is gone.
हम तो छोटे छोटे लोन देते हैं, हमारे आसपास देखो जैसे रेडी लगाने वाला है, गोलगप्पे बेचने वाला है, टिक्की बेचने वाला है, वो आएगा सुबह सुबह बोलेगा बहुत ही 10,000 भाई हम कितना लेते हैं, दिन का 5% ब्याज, दिन का 5%, दिन का 5%, दिन का 10, मतलब तू 10,000 लेके जा रहा है, रात को 11,000 दे, तो वो क्या लोन होता है, उसे पता भी है मैं 10,000 का सामान लेके जाऊंगा, टिक्की छोले भटूरे भटाना टमाटर बेचूंगा, 10,000 से 14,000 15,000 कमाऊंगा, 1,000 रुपए भैया को देने और उसके बाद मेरे को 3-4,000 रुपए तो मुनाफा होता है, पैसे है ही नहीं, रेडी लगाने के पैसे नहीं है, मेरा हमारा बिल्कुल से 100-200 बंदों की गलती है, आएंगे छोटा छोटा पैसा मंडी के 5,000 10,000 5,000 रुपए 100 लोगों से ले लीजिए रोज के बिजनेस सेट, तो लाख रुपए दिन का हो गया, 30 लाख रुपए महीने की कमाई.
This is happening in urban India. You can imagine what is happening in rural India. This is the reality of the true rates of interest that people pay when they are not having access to formal finance. When we look at the rates of interest that microfinance industry charges, we say, oh, he's charging 20%, 21%. We don't notice where will the guy go? They will end up paying 60%, 100%, 150% rates of interest. Banks are not going to them. And the industry has grown and gone through ups and downs. It's a story worth studying, the twists and turns of this industry over the last 3 decades. And it keeps growing. It keeps growing because it's providing a very, very useful service in civilization. It is displacing the money lenders who are charging crazy rates of. See what happened in Bihar. Microfinance activity pushes out these usurious loan sharks. For example, in Bihar, the share of formal sources in rural household jumped from under 22% in 2012 to 47%. Because the loan sharks are moved out. Because why would people go to loan sharks? The Shylocks. The people who will take your pound of flesh. If you look at the interest rate comparison, they were charging a high cost of informal lending, 5 to 10% a month. In extreme cases, which we saw just now, 10% a day. These companies are charging 20-25%. They look high optically, but you need to have that kind of rate of interest to earn a reasonable rate of return on your investment, because you are lending money to poor people at the bottom of the pyramid. And I'll talk to you about how they handle risk over there. It's important for us to understand the business model itself. But I want you to look at it from a very pragmatic, societal point of view, instead of looking at it from just the optically, the rate of interest that they charge. I give you an example of a refrigerator. A woman buys a 40,000 rupee refrigerator. With 5,000 bucks she puts up of her own money, and 35,000 bucks she takes a micro loan at 20% for 3 years. And she says, I am the only woman in the village who has this fridge. You want to make dahi? You can come and make dahi in my fridge. Put it in my room. I'm going to rent out space to you in my fridge. $5 for one night. She gets 10 people to give $5 per one night. 1,500 bucks a month. Total revenue is 54,750 bucks. She makes a IRR of 20%. Exceed the loan 20%. Sorry, her ROE is 158%. She is now an entrepreneur. In 3 years, she can pay off the loan and she'll have the fridge to herself. And she can then keep doing it again and again. She can use the money to buy something else. I'm just giving you an idea that the IRR of these small ticket, small loans, small businesses, small entrepreneurs, the Silai machine, the refrigerator, the fellow who opens a small store, these small shops, the small entrepreneurs, they won't have a business without this money. With this money, they have a business. They pay 20%, 22, 23% also, but their IRRs are very, very high. It's a question of, okay, fine, you want to make it 12%, do it with your own money. Don't be judgmental about these companies charging 20, 22%. First, also remember that if they are not there, these same guys will not be in business. They can't afford. They can't afford the other thing. If microfinance wasn't available, she would have to go to the other guy. In extreme cases, 10% a day, 1 day's interest would equal 2 months of revenue. It's unviable. Businesses that are completely unviable, with loan sharks dominating the market, start becoming very viable. They create employment. They create economic activity. They contribute to GDP. There are downstream effects of it. The money is then used by the family to educate the children. The point I'm making is, we are so judgmental about these companies that they are charging 20%, ये बहुत high है, इसको कम होना चाहिए and all that. I think this is very, very pro-social. To be sure, there are bad apples. To be sure, there are some aggressive recovery practices which should be curtailed. All of that is true. But the real story is what we don't read about. That's the story that gets reported. The real story is tens of millions of people who have benefited. Those stories don't get captured by the media. You only see the bad news. You don't see the good news. And the regulation has become supportive. One of the things which I have learned over the years is study regulation from a historical point of view. Don't study regulation जो अभी हो रहा है. Regulation has become very pragmatic. Earlier they said we will curtail your rate of interest that you can charge. Okay, you want to put a cap on the rate of interest I can charge? I will withdraw from the market. Doesn't make economic sense for me. I will withdraw from the market. Then what happens? RBI realizes, oh shit, micro lending has stopped. Now these guys have to go to loan sharks. And we can't find loan sharks. They're like so small. We don't have the ability to go and find every loan shark and put them into jail and regulate them and tell them you don't have a license. Like what we're finding in finfluencers in our community who are unregulated. How if SEBI over-regulates the regulated guys, they're going to say, hum hat jate hain yaar. Then the finfluencers or the unregulated ones, they will come and take advantage of the gullible investors. It's the same thing. Regulators have become extremely pragmatic over the years. If you look at the regulatory environment changes that have happened over the years, they come, they do something, they realize they've overdone it, they withdraw, they move away. They say, no, we have overdone this. Look what happened only a few days ago in Delhi. We have vehicles which are old. She got the fright of her life when she realized that she is not going to be the chief minister. One day she's saying, I will not give you petrol and diesel if your car is old. Police will go to, they're going to impound your vehicles. 3 days later, she's going to Supreme Court and telling him, please, this is not right. You should allow these vehicles to be operating. Let them actually be polluting vehicles. This is not being done anywhere in the country. Pragmatism. Governments are becoming very, very conscious about their popularity, about their ability to stay in power, their willingness, their need to be elected and re-elected. And I think the regulator recognizes that this is a very important industry. It has a role to play. Politicians would step in and say, don't pay the loan, I will make sure your loans will get cancelled. And obviously, people will stop paying loans. Before elections, politicians will go. Telangana judgment came, only RBI can regulate microfinance. State governments can't do it. Suddenly, the state government will go and say, the chief minister, because he wants to get re-elected, elections are coming, will go and give an order to the deputy commissioner, DC, or they tell the people, no need to pay. Obviously, he wants to win the votes. So, if you look at the long-term trend, it's excellent. The terrible regulations are going away. The government is recognizing, the regulators are recognizing this is a very important industry. We need this industry. It has very huge pro-social benefit for the country, and it is basically part of formalizing India's economy. and it has survived through cycles. There have been, of course, it's not like a a typical lending in Kotak or a well-run HDFC bank kind of a business where every year the assets under management and the interest income and the pre-tax earnings and the post-tax earnings, the EPS are higher than the previous year. That's a long. This business it's inherently cyclical, and unfortunately, these cycles are not like agricultural cycles, which you can predict. They're not like steel cycles or shipping cycles, which you can predict that this will take so many years. These cycles come out of nowhere. Suddenly there's an Assam problem. Suddenly there's a problem in the flood in some state. Suddenly there is a COVID, comes out of nowhere. You are lending money to people at the bottom of the pyramid. They are fragile. And yet, if you look at it from a dispassionate point of view, the survivors have thrived in this environment, created enormous amounts of value. How have they done that? They have practices in place which are very good. They have prudent risk diversification. They have ample capital buffers. Unlike banks which have 13, 14, 15% capital adequacy, they have 25, 30% capital adequacy ratios. They have very high interest margins, The NIMs in this business are much larger. They're borrowing money at 9 or 10 or 11%. They're lending money at 21%. They have 10% margin spread between the rate of interest at which the money is being lent versus the rate of interest in money is being borrowed. That 10% can absorb a lot of shocks. It's a very people-intensive business. So the entry barriers are high. Banks don't want to be in that space because it's giving out around 50,000 rupee loan is not the same thing as giving out a 50 lakh rupee loan. So there are fairly high entry barriers from a bank's point of view. So if you look at the survivors, and here I want to talk about the Lindy effect. If you look at, again, I don't want to name names. I want you to consider the possibility that in a business and industry which has a useful role in civilization, has grown and grown and grown over the years, is likely to continue to grow over the years, has a bunch of players who has survived and thrived in an environment, even though when they got hurt a little bit because the down cycle is a feature or a bug, you have a way to invest in those situations. You look for those strong track records. The Lindy effect applies. If you have been in business for 30 years, the chances that you're going to be there in the next 30 years are much higher than if you were in the business just last 5 years. The aggressive players will drop out of the game. The dumb competition will drop out of the game very, very quickly. So the smart guys will very happily cede market share. We don't want to get into this nonsense behavior of our competitors. And you can watch that. You can observe that by studying the financial statements of many of the players which have been, again, not just talking about NBFCs, I'm talking about small finance banks also. There are these various business models that have come in the last few years. So I feel it's a bright future, and I think it can be approached pretty much the same way that Warren Buffett approached Wells Fargo. So in Wells Fargo, he looked at chaotic market, investor distrust, he looked at the scale and performance of the business, he looked at the various kind of risks that are specific to that company, earthquake or systemic. He was thinking probabilistically. He did a stress test. You can do that same thing. What is the worst case what is the worst that has happened? How badly does this company do in a really bad cycle? In the last 5 cycles, how badly does this company do? What happened to the ROEs? What happened to the EPS? What happened to the drop in earnings? What happened to the ROAs? What happened to the capital adequacy ratio? Did they have to issue more shares, take in more equity to boost their capital adequacy ratio, or they were able to do without that? Test it, stress it, put the thing to stress test in the past and see what happened in the past. And you'll be able to separate the men from the boys. And again, it's not a surety, it's just a probabilistic assessment that if you have survived through certain practices, several past cycles, then there's a very strong chance that you will survive this one too. It's not a sure thing. You will survive. But the market prices are saying that the earnings next few years are going to be decimated. That's what the market prices are saying. So the same thing, just keep buying, welcome low prices, Now my question to you is this. We looked at various special situations. We looked at Anagram Finance, SBI, Magnum, Triple, UGS 10,000, Pond, HUL, Nirma, Arcata, and Castrol on one hand. And then we looked at some conventional investing cases, Amex, Wells Fargo, Canfin Homes, Balkrishna, IRFC, Cochin Shipyard, Rights, Muthoot, and Micro Lending. Apart from the fact that these are special situations, these are conventional, what is another big key difference between them in terms of what is required from the investor's point of view?
They are good businesses anyways. Downside is limited, upside is higher.
Okay. I'm talking about from an invest. Forget about the attributes which are important from the point of view of the business itself or the situation. I'm talking about from investor's brain. You know, what does he have to?
Even if the special situation doesn't work out, the investor will do well in the second case.
Okay.
This can give the returns were kind of known ahead of time in special situations. Some kind of here, some kind of durable negative, but sometimes so that is acting as a special situation. That in a normal investing, that event is or some kind of a development from a company or some negative situation is offering that risk arbitrage.
Right. But that is there here also. There's something negative which is producing a possibility. So, yep.
Temporary negative.
No, again, don't talk about temporary. Don't talk about the situation. Talk about what's happening to the investor. What kind of?
Getting a good value at a distressed time and getting into a good business at the lowest valuation.
Okay, let me give you a hint. What are the different kind of diligence that you have to do in this one versus this one? Say again.
We don't need to look at the face who is running with it. In case of special.
Okay, that's the benefit you think. Okay. Okay, that's a good one. I still don't have the one which I had in mind. Let me just talk about that. Did you stand up to tell me the time to stop or no? No, again, that's specific to the situation. Talk about the diligence, what you are to.
You don't have to read the fine print in the second case. That is very.
So you're on the right track now. Okay.
Needs the fine print, the financial due diligence, notes to accounts.
Okay, let me answer this. Go back to Anagram Finance. We buying it for 12, 13, 14, 15 average, 18. Okay. It's a credit risk on ICICI. वो देगा कि नहीं देगा, right? SBI Magnum buying over NAV, but there is a promise. SBI देगा कि नहीं देगा. UGS 10,000. Interval fund, market has gone up. I am getting it at historic pricing. I have 1 month left. I will go and redeem in 1 month. In that 1 month, market कहाँ जाएगा? Business का कुछ नहीं पता मुझे. I don't know what is in the portfolio. वो market गिर गया तो मेरे को नुकसान हो सकता है. I'll take a chance for the next 3 weeks are left for me to redeem. What will happen to the market? Okay. Ponds, HUL, it's an unhedged position. I'm buying this. I'm creating cheap shares. What will happen to the stock of the HUL at the time? Because I'm an arbitrager, right? I'm not really trying to buy HUL cheap, I'm just trying to make the spread. Buy this, sell this, make money, go home. Nirma, warrants, by the time I get the shares, warrant, what will happen to the price of Nirma? Nirma will collapse, share price, so kya hoga? Arcata Corporation, same thing. Castrol, will they give or not give? In every one of these situations, I was predicting either stock prices or the behavior of other people over the short term. And in each of these cases, I am thinking about how the business will do over the long term, not how the people who run the business so my shift, it's a mind shift. It's a huge shift in the mindset. You're no longer thinking about how people behave or how stocks behave or markets behave. You're thinking about how businesses will do. So from being a security analyst and a market analyst, you're moving towards being a business analyst. It's a massive mind shift. It's a total mind shift. Same tools, same methods, but the mind shift is totally different. And there is more. You see, Ben Graham's special situation strategy exemplifies an outcome-focused approach. Everything is about outcome. Kitna milega? Always looking at the outcome. An investor bets on a specific event and continuously weighs the expected profit versus loss. He asks 4 questions. How likely the promised event or tender offer merger will happen? How long will it take? What are the chances of even better outcome? The Buffett 4 questions. What happens if the event fails? These questions show how outcome-driven this style is. A special situation investor is essentially playing probabilities with each deal, estimating upside if all goes well and downside if it falls apart. Every decision centers on expected returns and risk. How much can I make? How much can I lose? What is the probability of each scenario? The focus is very much on the scoreboard of investing, the eventual profit or loss on the deal. The life of a risk arbitrager involves watching spreads and news flow constantly. It's a demanding, outcome-centric mindset, one that requires constant attention to results and payoff probabilities. This technical branch of investing requires a special temperament, as Graham mentioned in the beginning, we talked about that, and relentless calculation, continuous calculations. Special situation investors are perpetually watching the investment scoreboard, tracking whether each situation will deliver the anticipated Lakshmi or wealth in the form of returns. But if you remember what Krishna told Arjun in the most famous part of Mahabharata, we all remember that. Ancient wisdom from Bhagavad Gita advises us not to remain fixated on outcomes. Arjun is counseled by Krishna to fulfill his duty, dharma, without attachment to the results. So don't think of expected returns. The Gita's famous verse encapsulates this philosophy. You have the right to perform your prescribed duties, but you're not entitled to the fruits of your actions. It's a focus on the work at hand and let the outcomes take care of themselves. This principle of process versus outcome, we are familiar with that, is the cornerstone of many philosophies. The idea that by concentrating on one's actions and principles, that is one's processes or one's duties, you paradoxically achieve better outcomes in the long run. The Gita explains that results depend on many factors beyond our control, and obsessing over them only creates anxiety. And I've gone through that. Those sleepless nights. कि कल क्या होने वाला है सुबह, वो कोर्ट में क्या होगा, वो सीवी क्या करेगा, वो सैट क्या बोलेगा, ऑफर वो रिजेक्ट करेंगे कि नहीं, बुक बिल्ड होगा कि नहीं होगा. Instead, if one pours full attention into doing the work well, the results are even better than before as a natural consequence. This, by the way, is also part of Stoic philosophy. As I've grown older, I'm becoming more and more philosophical. Epictetus wrote that happiness and freedom begins with a clear understanding of one principle. Some things are within our control and some things are not. It is only after you have faced up to this fundamental rule and learn to distinguish between what you can and can't control that inner tranquility and outer effectiveness becomes possible. Trying to control or change what we can't can only result in torment. Remember, the things within our power are naturally at our disposal, free from any restraint or hindrance, but those outside our power are weak, dependent or determined by the whims and actions of others. This is so powerful in the context of my decision of moving out of risk arbitrage. I already talked about that. Krishna and Epictetus told us what coaches often tell athletes. Don't watch the scoreboard, focus on the playing field. By concentrating on executing the right process, staying disciplined, minimizing mistakes, the scoreboard, the outcome will eventually reflect that effort. Excessive focus on results can lead to stress and self-consciousness, which undermines execution. Conversely, immersing yourself in the process often results you being in a state of flow, peak performance state, where one is fully absorbed in the task. Winning is a byproduct of executing the fundamentals and focusing on the process. Focus on the process and the aspect of performance you control. The process will eventually reward you with success. In the realm of investing, Krishna's advice would be to would translate to focusing on the quality of your analysis and decision-making process rather than fixating on the short-term profit or loss of each trade. It means acting with discipline and diligence, doing your homework on a stock or industry without letting the day-to-day market fluctuations or outcome anxiety derail your strategy. Now, how do we reconcile the outcome-oriented mindset of special situation investing with the process-oriented wisdom of the Gita? I think the resolution lies in reframing one's fundamental pursuit. Chase knowledge, not money. In Hindu philosophy, this is depicted in the distinction between Saraswati and Lakshmi. Goddess Saraswati represents knowledge, wisdom, and learning, whereas Goddess Lakshmi represents wealth and prosperity. One big lesson is this: if you pursue Saraswati, that is knowledge, wholeheartedly, Lakshmi, that is wealth, will become jealous and follow you. Devotion to knowledge eventually attracts wealth. A popular parable retold by Deepak Chopra illustrates this point. A young man asks a spiritual master for a secret to unlimited wealth and success in helping the world. The master answers, there are two goddesses that reside in the heart: Lakshmi, the goddess of wealth, and Saraswati, the goddess of knowledge. Both are loved, but you must pay more attention to Saraswati. Pursue her, love her, and give her your focus. If you do so, Lakshmi will become jealous and pay more attention to you. The more you seek knowledge, the more wealth will seek you. Lakshmi will follow you wherever you go and never leave you, granting you prosperity. For an investor, chasing Saraswati means prioritizing learning and insight over immediate profit. It means that when researching companies or industries, your first goal is to gain an understanding, not just hunt for the next quick trade. You might delve into studying a sector deeply, its competitive landscape, technologies, economics, without any guarantee that it will pay off this quarter or even this year. Initially, this pursuit is for knowledge's sake, much like doing one's duty without attachment to the outcome. But that knowledge accumulates and compounds over time, often in unpredictable ways. Serendipity plays a big role. The industry study that yielded no opportunity today might help you recognize a fantastic investment years later. The process of learning builds your circle of competence, to use Buffett's term, expanding the range of businesses you can evaluate astutely. It also enhances pattern recognition. As you have seen many scenarios, you can better discern emerging opportunities or red flags. Embracing the Saraswati over Lakshmi framework can change how one approaches investing day to day. Instead of asking what stock will make me the most money fastest, an investor might ask, what can I learn today about businesses, industry, or a concept that will make me a better investor in the long run? By immersing in the research process, reading financial reports, studying business models, analyzing past mistakes, both yours and those of others, you will be worshipping Saraswati. The immediate outcome, whether a particular stock pick wins or loses this month, will become less critical than the incremental addition to your knowledge. Over time, this knowledge bank will become a powerful competitive advantage. When a truly golden opportunity arises, you will be able to recognize and seize it. Whereas someone fixated only on chasing Lakshmi might not have developed the insight to discern its value. We can see this in the careers of many great investors. They often spend years studying various industries in special situations, sometimes without any direct payoff at first. For example, one might spend months investigating a complex merger transaction, not solely for the immediate trade, but to understand how mergers work, how boards and shareholders behave, how to gauge regulatory risks, etc. That know-how can later be applied to more traditional investment, perhaps identifying a company that becomes a takeover target, or how a company can use an overvalued stock to buy an undervalued business in a stock swap to enrich its shareholders, much like Henry Singleton did in 1960s and 1970s, or 1960s and 70s, and how great businesses can create value while growing their revenues and earnings, while at the same time shrinking their share count massively through stock buybacks, tender offers, like AutoZone and Apple have done recently, and how Henry Singleton done in 1970s and 1980s. These are all case studies in my other courses. This approach also cultivates resilience. If you possess the knowledge focus, setbacks, if you are process and knowledge focused, setbacks don't deter you much. A failed investment that is an outcome where Lakshmi didn't show up is not a total loss if it taught you something new or reinforced a valuable lesson. Instead of seeing it purely as lost money, you see it as a tuition in the school of investing. This mindset keeps you emotionally steady and intellectually curious. Key traits for long-term success. It aligns with Krishna's advice: you did your duty. If the outcome was adverse, you learn from it, but do not regret the process you followed. You remain focused on improving your craft. Over many cycles, this attitude leads to superior results because your decisions will improve. Applying Saraswati Lakshmi framework to investing means committing to the pursuit of knowledge and excellence in process, trusting the financial success will be a natural consequence. In that sense, when Ben Graham's special situations framework taught me to calculate probable outcomes rigorously, the paradox is that my best outcomes arose when outcome chasing took a back seat to learning and sound process. Lord Krishna's timeless lesson to focus on your duty and not on the fruits turned out to be not a rejection of the success, but a guidance on how to achieve it by attending to the work itself. For aspiring professional investors, this is heartening philosophy. Every bit of research, every industry you study, every investing mistake you learn from, all of it adds to your wisdom. None of that effort is wasted because it's compounding intellectual capital. Eventually, that store of Saraswati's gifts will translate into superior investment results. Focus on the playing field, not the scoreboard, and you will play better. And ironically, rack up more points in the long run. In practical terms, don't obsess over daily P&L, obsess over whether you are studying the right things and executing a sound strategy. If you get those factors right, the profits, Lakshmi's reward, will come naturally to you. Thank you for your attention to this matter. Okay, so I just finished it exactly when you told me to, 1:30. You can have maybe 10 questions. Will you count? Question number 10. We'll go downwards now. And from different people, please, not the same person. Yeah.
In the Redwood transaction,
Yeah.
because the rights to payoff happened 5 years later, was Buffett required to hold any shares because he'd already tendered?
No. This is very similar to what happened in VSNL. I don't know if you know this, but Tata Communications was acquired by VSNL.
BSNL was acquired by
VSNL was acquired by Tata Communications. VSNL had parcels of land, which was not part of the sale transaction. So people who tendered the shares still retain the claim on that land. That company is now Hemisphere Properties. So you still retain that. Even if you sell that, you still retain that.
So essentially for 5 years there was no capital down also.
But they kept on holding. I mean, they got their money also. I mean, he said that we got their money subsequently. They may have sold off the business, but
Thanks for the great talk. It really changed my perspective on microfinance. So my question was that these microfinance companies, since you told us about the virtues of them and you said that they can be considered as good investment candidates like we do for HDFC Bank and Kotak Bank. So two questions there. One, we know that paying a 2 to 4 times price to book for a great lending institution usually ends up in a good outcome, and these are great buy for 10-20 year kind of investments. So for microfinance, because there is a thing called like in 5 years you make profits and then one big loss comes and all of those gains are wiped out. So can we apply the same buy and hold frameworks to microfinance, and how do we value these companies?
No, I don't think you can apply the same framework. There's time to own them and time to let them go because there are cycles. They're not like compounders that you will buy and hold for the longest time. At least I'm not in that frame of mind as of now. 5 years from now, if you ask me, maybe I'll have a different answer. But right now, at my current phase, I don't think of them as perpetual holds. The time to buy them is when they're out of favor, massively out of favor, and probably selling at very high P multiples because the earnings have disappeared. But you're calculating the P multiple the wrong way there, because you should calculate it on the basis of average earnings or what you think will be the normalized earnings going forward compared to the price. So I think you really have to look at it each business separately. On the price to book versus price to earnings, a very interesting topic. Very simply, you see, every business you're buying earnings. book value is an important sanity check in terms of what is the price to book value ratio. But let me just give you a hypothetical example. Let's say that you think that the business is doing extraordinarily well on earnings and the earnings will keep growing and the stock is available to you at a very cheap valuation of, let's say, 11 or 12 times earnings, right? Supposing that happens. But you buy that stock, it so happens that at this time it is also selling at 3 times book and you think it's too expensive. A lot of people will say, oh, 3 times book is too expensive, even though it is selling at 10 times earnings. You think 10 times earning is cheap, but 3 times book is expensive, so you don't buy it. The problem is, how do you make it cheap on price to book? By keeping the price the same but increasing the book. That means you tell the equity investors to put more money in the company, increase the book value. That means investors should put more capital in the company to make it appear cheaper, even though the earnings will remain the same on that book. Earnings don't change, investment of the investors goes up, the price to book value will go down. On every dimension it will look inferior and you will start thinking now it is more attractive because the price to book has come down. Is that logical? No, it's not. The only reason why you have to use price to book will be that you think that earnings are going up and up and up. How sure are you these earnings will continue to go up? Because if there is no entry barrier, then somebody will enter the market and destroy this superior earning capacity, which is where price to book comes. Because if the book value of the stock is 100 and the price and the stock is selling at 300, that means somebody will have an incentive to create asset which will immediately be floated in the stock market for 300. Because the asset creation cost is 100, you can convert them into $300 in the stock market. That's what price to book means, right? And it's very quickly. It's not like a steel plant or a shipping company where it takes 10 years to build. You can do it tomorrow. So the reason why price to book value is important is that it's a sanity check. The entry barriers are there. If the entry barriers are very strong, then price to book value becomes not that an important criteria. It should be high. Therefore, you have to be very careful on the price to book value to use price to book value ratio. Should not be used very much. The other problem is when the scarcity aspect of it. A lot of people use the scarcity of banking licenses as a reason to pay high price to book value ratio. I don't buy into that argument. So we can get into a lot of discussion on this, but I think for the most part you should do price to earnings with the caution, with the caveat that earnings should not be extraordinarily high, which will make you overpay for a stock. So when you're paying 10 times earnings, you may actually be paying 15 times earnings because the normalized earnings are not in the denominator. You took the wrong denominator, which means that you are really paying high not only high price to book, but you also paid high P price to earnings. So be careful on the earnings aspect of it. I have to move on to something else now. Some third question.
Just a couple of questions. One, can you talk about how you look at earnings versus cash flow?
Can we stick to the presentation? I don't want to talk about something outside the subject because we are here for that topic. So let's stick to that, please. You can come back. You can come back if you want. Yeah.
Professor Bakshi, was a delightful talk. Thank you. I just wanted to ask, over the course of analyzing from special situations and your own kind of evolution as an investor, to what extent do you think top-down factors deserve attention, or to what extent have they entered your thought process as far as special situation evaluation goes?
Firstly, I'm not doing special situations evaluation right now. I'm using the methodology in what I do right now.
Sorry, I meant in that
okay.
Methodology or framework applied to value investing.
How much? Oh, I don't do top-down very much. I am for the most part a bottoms-up investor. Again, I'm not saying that top-down is not important. It's not my game though. The reason is there are so many more factors when you do top-down, and the variables are very difficult to predict. But bottoms are easier. A competitive advantage, a cost advantage. Why do customers love a company products? Why will they keep loving the company's product? Why it's hard for somebody to enter the companies, enter the industry? Why if there's a cartel, the cartel is likely to continue, and so on and so forth. So those pricing power, cost plus contracts, ability to pass on the pain to the customers, those are all bottoms up factors. Those are microeconomics. So I always feel microeconomics is easy to understand and it plays a huge role in actual value creation of in the world. But when you start thinking about GDP growth, interest rate changes, exchange rate changes, or what will happen to different countries trade this thing, they may be important, but when you're investing in companies, you can take care of that angle by saying that I don't want to be only in exporters. I want to have exporters and importers. I want to have domestic consumption also. I want to have B2B, B2C also. I want to have B2G also. That part can be taken care of by having a diversified portfolio. So you're basically taking away the need to predict certain things by having protection built into your system in portfolio construction process. That's the way I look at it. But by no means I'm saying that top-down investors don't deserve attention. Many of them are purely top-down investors, and it's just something that I don't do. I think, is that what you wanted me to answer in top-down?
Yeah, and totally. By top down, I didn't mean macro. Just to clarify, I meant more like certain kind of secular themes in terms of demand for certain kinds of goods and products that might continue. And the reason I asked that question was actually because I did notice a lot of your recent not recommendations, but recent kind of
none of those recommendations.
My mistake. Bad choice of words. A lot of that recent stuff was in the financials domain, and I was wondering.
Yeah. Oh yeah, that's by design. Because what has happened is, in the last 4 years ago, it was all PSUs. I was only pounding the table with PSUs. That day is gone. Again, the reason is that that's where the money was. I think cheapness was. It's not that I love PSUs just for the heck of it. I just love the prices. And today I see it in two domains: fossil fuels and finance. Last 2 years I've been looking at that space. I think they're like deeply prejudiced against, for the wrong reasons. I think we'll find out whether I'm right or not. But yeah, I think 60% of the exposure is in financials. It's like really, really high. Again, different. I think when people think financial, at some level there is a correlation. Financial stocks have a certain amount of correlation to interest rate risks and all that. But not all financials are correlated. A housing loan company is not the same thing as a gold loan company, or a commercial bank, or a microfinance company. They are not the same animals. They are very different things. So to treat them all just because the label is financials, I think that's a misleading label. Yeah. Anybody? Yeah, you can take that.
Professor Bakshi, what I understand is that the special situations emerge when there is something extraordinary that has happened. And one way to see today's circumstance would be probably IT industry. So because of the disruption happening of the AI. Now, my question is really,
when the valuation come to 6-7 times earnings, then we talk. Abhi extraordinary nahi hua hai.
It's in the process.
Yeah.
Because now growth has stopped coming in, and
but the stocks are still priced for growth. I want to get the growth for nothing.
Absolutely.
Yeah.
That's why I'm trying to understand the framework. How do you put it into it? Now, this is an emerging situation. It will happen over a period of time, but you just have to keep a watch on it. So when do you really get into it? Now is that really different?
See, I love the quote behind every truck. Buri nazar wale tera muh kala. I don't want the destruction to happen. It will be bad for the country. But if it happens, if it results in a massive overreaction, I'm there to make money. I don't want to hope that it happens. I only respond to an opportunity that will occur when there's a massive overreaction to some bad news. The development of, and I was reading something that these IT companies have returned $25 billion, I think. TCS, I was reading, over the last 25, 30 years in dividends. And they and look at what Nvidia has done, and look at what other companies have done, and this. So the mindset is very different. These companies, on an innovation paradigm, if you look at the spectrum, they don't want to lose money. They don't want to. They're not like Elon Musk. They're not like Zomato founder. They are very. These people, if you put Narayan Murthy with or the people who founded great companies, no question about it, lovely people and businesses that they've created, in the room with the risk takers of the world, you find that they are very, very different people altogether. So, the people who have no desire to take any risks should live content with what they have. And it is what it is. We as investors don't have a right to make any changes in that. We don't control these companies. So we have to live with the situation that the people who run these companies, they don't want to they would rather return the money and not invest in AI and not invest. They could have done it. They had the money. They didn't because they thought it was too risky. So they don't want to take the risk. Fine, it's their call. They've done it. And we have to deal with that. They have to deal with that, and people who are invested in those companies have to deal with that. But as to the question about overreaction, to say that IT services industry is going to get completely decimated and becomes unviable, I think that's wrong. And I hope that at some point the stock market prices will reflect that. That's not the situation right now. If that happens, I'll be very happy to put money in that industry. We're nowhere close to that right now, in my view.
Professor Bakshi, my question is around how do you structure your portfolio or asset?
Stay with the topic.
Yeah, and with this question is how to take advantage of some of it. Because my problem is I'm eternally invested and I don't sell my stocks. And I get 3 ideas every 6 months. Hey, this is a great thing to pursue. But I don't have the right cash.
How have you done in life? Well,
yeah.
ठीक है ना फिर problem क्या है?
Okay, let me rephrase my question. Is there a good
there will always be opportunities that you will never even get to know the opportunity that you miss. These are the ones which you saw. There are so many opportunities that you miss that you won't even get to know. How does it matter?
So my question is does it make sense always to have, let's say, 10-15% as liquid assets? Because
there's no right answer here. There is no right answer. You can be in cash waiting for the right swing to come, which may never come, or you may be fully invested. I am almost fully invested. The only money I have is for personal reasons. But I respect Buffett's philosophy as well. There is no right answer here. It depends on whatever is right for you. So I really don't want to answer that. I don't have a response to that. Yeah. The orange, the pink, you're the one who's standing.
So my question is, we mostly talked about something happening in the risk arbitrage. What about the other side of it? Something not happening. And in times when the market euphoria is there, I think it becomes even more important because the stocks are already overvalued to by some extent. So the juice is not there. So even if something happens, it's already inflated. So the upside will still be limited. So is it the norm that in such case, even if you apply that risk arbitrage framework in value investing, where there are no contractual obligations for payoff, it's still coming from the business. So do you still go in with the view that this is not going to happen and the price will go down? Or does that?
No, I want to go in when the price has gone down. I want to go in after the price has gone down as a reaction to some adverse development. So I want adverse developments. I want massive. By massive, I means several. So I did actually can you shut the door? So I did not cover one case, which I did many years ago. Actually, it's on my website, one of the special situation document on ITC, many years ago. There was a CGAT case. CGAT stood for some excise duty something. So ITC was levied. There was a court case in which they lost the case. Some government body CGAT levied some penalty on the company. And I wrote in that article, the stock dropped 5x the amount of the penalty. Penalty maximum is known. And then I wrote that this penalty is, firstly, they will go to appeal. They may win or they may lose. Nobody knows. They may win, they may lose. Even if they lose, 2 things will happen. They don't have to pay this money right now. They have to pay it over a period of time. The DCF value of that loss is lower than what the actual nominal value is, and the market prices of the market cap of the stock is down 5x the max loss. And the third thing was that the loss is tax deductible. ITC is a very cash rich profit making company, and if they have this loss, So the worst case scenario on a per share basis calculation, which I've done in that thing, was so small, but the market price was down now so much more, it looked like a no-brainer to me. So you want bad things to happen to good companies. But when bad things, you don't want them to be really bad, but the perception of that should be horrible in the minds of at least some people who own the stock, and they panic and they run and they say, Niklo se, sell at any price. And that produces that massive overreaction, and that's when you're waiting. So basically, the screen will effectively tell you what are the businesses whose stocks are massively shut down. So if you were to just say you have a subscription to Perplexity Max, or you have a subscription to ChatGPT Pro, okay, you will ask, show me the list of companies whose market caps have dropped very significantly in the last very short period, 20 days, 30 days. And then I want you to correlate that with some development that has happened in this company. And I want you to tell me the exact notification that has come on the NSE, BSE about this company. And then I want you to tell me what is the problem. It'll give you everything. If you do it correctly, it'll give you everything. Then you have a list. There is a reaction. Now, to see whether there is an overreaction or not, you have to see first you have to make a list of reactions. From that, you have to find out the list of overreactions. To evaluate the overreaction or not, you look at how bad is the problem. That will be deep dive. That will be human. So you'll use AI and human intervention. Deep dive. What is the situation? And by the way, just because the stock has dropped 40% doesn't mean it has become cheap. This is what I think applies in IEX kind of situation. My view, may be wrong. The stock may have dropped 28% in 2 days. Doesn't mean it is cheap. It may still bounce back, by the way, but for me, it has to be cheap from fundamental numbers. We are fundamental investors. It has to be cheap on average earning power of the future. If somebody asked me about IEX and asked me 3 months ago and 6 months ago, and my answer is the same. The regulatory landscape of this industry is shifting so rapidly that it is impossible for me to visualize what this industry will look like 5 years from now. And if I can't visualize what the industry will look like 5 years from now, I don't want to go there. Not my game. Maybe your game, maybe somebody else's game. Some people are very good at predicting how this particular industry will change and regulation will come and decoupling will work and all that will happen and not happen. I don't know. So I don't want to go there. So it's not for me. But superficially also, it has to come down to single digit multiples of earnings, normalized earnings, for me to get attracted to something like that. Not just because the stock has dropped 10%, 20, 30, 40, 50%. It has to. So Nestle, had the Maggie problem. The stock never dropped. But it was something I was waiting for. I thought, ye to bahut acha fraud hai. Maggie will come down 10 times earnings, main to sab kuch bech ke kharid lunga. But hua nahi. And my daughter was traveling, she came back and she said, Papa, this Maggie which they have changed is not tasting as good. I want the leaded version. So I knew the consumer behavior is very different from this. And the stock market did not actually overreact in Nestle at all. So Indian investors also becoming quite savvy on that front. Yes.
So if this phenomena of stock price, there not being adverse price action and this being systemic, which is what is happening today probably, there are not enough opportunities. Do you actually enter with the view, with a bearish bet that too much of a good price action is happening, not adverse? Because if you keep on waiting for an adverse price action in any euphoric market,
I'm not waiting for something. It's not like okay. You're looking for either a company specific problem. We saw that Canfin Homes kind of a situation, or an industry specific problem. Now, company specific problems are going to result in the drop in the stock price of that company itself. KRBL is a very good example. I did not participate in KRBL. I felt the KRBL problem was a more severe problem about what was happening. The fellow was in jail, and there was these issues and there was this defense angle to it, and there was something about it which made me feel that ye meko nahi karna hai. Some gut feeling, some intuition, I don't know what, but I didn't touch KRBL. And I know people, I have very good friends of mine who are massively into that particular business. And I didn't do that because there was this massive government intervention and there's suddenly, whole lot of, I don't know if you follow the story, but a lot of things happen in that company. And so I did not. So there are I cannot put a finger to it, but there are some things. One of the things which I've learned: if you keep doing some things over the long term, you start trusting your intuition. Something your gut will tell you this is interesting, this is not interesting. So in Canfin Home, we've seen in IRFC the chairman into jail. The company, the chairman is arrested. But the fact is that he was arrested because of something he did earlier. No problem at all. My convictions is in the business. There have been other companies in which you invested. The CEOs have left, they've quit, they've fired. Again, you have to go into the situation as to what has happened. But the market prices don't always behave in like that. So if the problem is specific to the company, you have to really go deep. How bad is the problem? And there will always be information asymmetry. You will never have full information. There will always be situations when you think you know everything and then suddenly some negative information comes. Therefore, it's always better to take it easy. Don't act in haste, because when the market reaction happens, they don't always go back very quickly. The recovery is never very quick. And even if it is very quick, let it go. You will have time. What does happen is that the crash is very fast, and then when the remedial action has happened, like Canfin Homes, when the clarification has come, the recovery is never that fast. So there is always that period of time during which you can build your position after all the facts are there, after all the work is there, after you can do the research, after you can do the homework. Everything is there in place. People just don't want to do it because once bitten, twice shy. People who are already owned, they have sold, they don't even want to look at that thing anymore. So they bolte hain, nikal gaya, ab mere ko dekhna hi nahi hai. They don't want to look at that stock. So that prejudice starts coming in. So there comes an untouchable kind of thing. So that was one company specific thing. Then there's an industry specific thing. It's a Hyderabad company. Humko chhuna hi nahi hai. Could be something like that. This is not industry, but this is like a location thing. North India mein sab chor hote hain. Or this industry is a cotton yarn industry. Cotton yarn is a lousy business. Who's going to make money in cotton yarn? But once in a while you will find an Ambika Cotton, you will find a KPR mill. You'll find again. I'm talking about finding them before they become recognized being what they are. So you're always looking for prejudices that the whole industry is disliked for pretty much the right reasons, but there are some parts of that industry which shouldn't be disliked in that sense. So again, the same framework sort of applies, that this is different, this is not the same, and this will become reflected in the market valuations over a period of time. Don't know when, but it should happen. So it could either be company specific, or it could be industry specific, or it could be something else. But you really have to look for some really major discrepancies between what the market price is and what it should be under more normal circumstances. Yeah.
Professor Bakshi, amazing talk.
Those of you who have come from outside of Delhi? So if you have any questions, we'll give priority to you because you've come from all the way. So if you want to be in the fast track, yeah, whatever you call that, you have to raise the hand. Fast forward, yeah.
Just one question. You talked about the microfinance industry and why you like it, but one of the narratives that has come is that a lot of the loans that are being given out right now are more for consumption than business, and people have gone ahead and bought so many things which have nothing to do with increasing their earning capacity, and that's the reason for what is happening right now. So, what's your view on that?
Mixed. When people buy a mobile phone, is it only for consumption or is it used for business, or both? When fellow moves from a Nokia phone to a smartphone, does he use it only for business, only for pleasure, only for watching cricket or watching movies or YouTube or Instagram, or for getting on a Zoom call? Maybe not Zoom calls in villages, but maybe using it for business, doing transactions on UPI, making his business more efficient with the help of smartphones. I mean, what is the answer? Do we know the answer?
I'm just talking anecdotally that
Exactly, these anecdotes create the narratives. Let the data create the narrative, not anecdotes. It's true that consumption is it's true that a lot of people overborrow more than they should, and of course the regulators have come in, and a lot of these companies also become this thing. MFIN has come and given their guardrails that you can't have more than three. This is a very good thing. By the way, if this results in a contraction in the AUM of the industry, this will be great news for me. What is happening is people are saying, "Oh, the AUM is dropping. This industry is shrinking." People don't realize when the AUM has grown and grown and grown, it's like you've eaten and eaten and eaten. Now you need to do some fasting, then otherwise you will be vomiting. It's exactly like that. So a period of slow growth or even negative growth in an industry which has grown and grown and grown for me, where I know the ultimate destination growth is going to be so much more, the size will be there, and right now they are here, and they've come from here to here in a very short time, and now they're going to be like this. I have no problem at all. I love it. If the market starts saying, oh, this is a no growth industry because this AUM has stopped declining, this is exactly what happens, by the way. If you look at the AUM growth of microfinance, it has dropped in FY25 across the industry. It's a very healthy thing that is happening. The other point I want to say, those of you who are accounting background would be, banging your heads in how to figure out accounting for NPAs. The oldest simple thing that a business analyst wants to know, that I have given out this loan, this is appearing as an asset on the balance sheet, how much of it is bad? How much money I'm not going to get back? This loan is 100 rupees. Will I get back 100 rupees? Will I get back 90 rupees, 80 rupees, 70 rupees? Will I get back nothing, or will I get back 99 rupees? That's what you really want to know. What has happened is that the regulators over the years have made provisioning and what is the 90-day thing? TBD.
ECL framework.
Yeah, so all of ECF is another animal by itself. I'm talking about PAR 90, portfolio at risk. What does that mean? That means if you are in the business of lending money to poor people are not good credits to begin with, but you have in place systems which allow you to manage that risk, and you have done that for the longest time and been able to do very well by lending money to poor people. The regulators, however, say that if you don't get paid in 90 days, if you're delayed by 90 days, make a provision. Even though you will collect the money subsequently, almost always you collect the money subsequently. If you study CRISIL note on Shriram Transport Finance, they say the same thing. That their gross NPAs can go to 7%, but they always get the money back. Their actual loan losses are way less than the NPAs. The point is, loan losses are not the same thing as NPAs. NPA means non-performing asset. The fellow was supposed to pay me, he has not paid me, so he's become non-performing. Can become performing later on, but it will happen in the next accounting year. And therefore, in this accounting year, if it is not performing, I have to make a provision. By the way, it's the best thing for accountants, regulators to require companies to do that, because bad accounting produces bad behavior. By requiring lending businesses to make aggressive provisioning, extraordinarily conservative provisioning, they ensure good behavior. Because what really happens? Moment you make a provisioning, you bring down your profits. Moment you bring down your profits and maybe convert them into losses, your reserves go down. Moment the reserves go down, your capital adequacy ratio goes down. Moment your capital adequacy ratio goes down, RBI says you can't lend anymore or bring more equity. So these are the checks and balances in place. So even though these NPAs may not result in actual loan losses, it changes the behavior of the companies. And if you look at the really smart players, they are very aggressive in providing early. And therefore, their accounting books will start showing drop in earnings, which are actually not really real loan losses. So the accounting is all messed up, but for the right reasons. And the analyst has to really make a distinction between real loan losses versus provisioning. And again, for that, you have to go to history. What has happened? What are the real loan losses that they suffered versus what they provided for? And all get merged into future quarters, because next year more provisioning is happening, so that is added to new provisions. Then there are write backs. So it is very complicated to figure that out, because the provisioning account is a very it's moving, continuously moving account. So the balance in the account is continuously changing. The people in that changing and moving on. Their write backs and more additions and all that. So all that is running through the P&L. So it gets very confusing. But at the highest level, what we're really trying to do is how much of the loans are going to turn bad. What we're really looking for are bad debts, the threat of bad debts. And bad debts is again a feature, not a bug. If you're running a bank where there are zero bad debts, either you're a fraud or you're too conservative. It's not possible to not have bad debts. Good one. Yeah. So again, you have to price that risk. You have to say, if you start lending your money so conservatively that you don't have any bad debts, think for it for a moment. That means you're leaving too much money on the table. That means your competitors are taking market share from you. Therefore, you need to relax your lending standards a little bit, not a lot, a little bit. So you have a little more bad debts, but you have a lot of other good credits also come in. And you have to calibrate that. And that happens and that is in micro lending, that is a continuously changing landscape in different parts of the country. It's not just one, it's not like one location. Assam, North Assam में कुछ और हो रहा है, South Gujarat में कुछ और, कर्नाटका में एक ordinance आ गया, वहाँ पे कुछ और हो रहा है. Every country, every district is different. It's a district level business. It's not a dashboard on sitting on one place and measuring consolidated numbers. So pain point in one part of the country are not there in the other parts of the country. Sometimes the problems are contained in just one location, and the moment that shit happens, you see what are the corrective action? What is the worst case scenario? How does it hit the balance sheet? I'll tell you one more thing. Anuj knows this. Many years ago, there was this NBFC which used to talk about the exposure to real estate developers, which he thought was very high. And in their con calls, they used to talk about that, our asset book is, let's say, 1,000 to 10,000 crores, and we have only given 1,000 crores to real estate developers. So only 10% of our asset book is real estate developers. But hang on a sec, you have 10:1 debt equity ratio. Your equity is only 1,000 crores, and 1,000 crores have been given to real estate developers. Half of that goes bad, 50% of equity is wiped out. I don't want to name the company, but and I don't want to smile like that fellow on in that DGM.
But was the name correct?
Yes. The problem is, you have to look at exposure to what matters to you. It is net worth which matters to you, not this thing. There was another one big one. They survived, but there were two of them. So even the risk management practices they talk about assets under management, not net worth. You should always, Buffett always looks at net worth. Always looks at net worth.
Yes, sir.
Yes.
Speaking to the topic of presentation.
Yes, thank you.
We started from a thought process of an arbitrage or a special situation to apply that to long-term investing, right?
Yes.
So the arbitrage or the special situation person knows when to exit. And this is my exit. We also discussed something like 80 to 100 wala cheez mein 96 pe I'm thinking, okay, now I'm going.
Yep.
How do we apply that to long term? When do we say
it's a great question. It's a great question. So this is what my learning from the subject, and I don't want to say that it's 100% correct, and there are massive paradoxes involved here. So when you're an arbitrager, there is no hold period. You're either a buyer or a seller. Either it makes sense or it doesn't make sense, because it's very short term. 10 days, 20 days, 30 days, 2 months, 3 months, 4 months. So you're calculating the expected return. If the return is dropped to a point where it doesn't make sense to hold on, you're out. Now go to investing, normal investing. If you pick 100 people in a room of really successful investors, you'll find that 95% of them are those who just bought good businesses and sat on their asses and did nothing. They ignored the noise. They did not sell them when they went up. They didn't care about bull market, bear market. They just did not look at the stock price at all. So in true wealth creation, in real equities, regular equity investing has a very long hold period. In arbitrage, there is no hold period. You're either a buyer or a seller. Now, this is the point that I asked Charlie Munger. Had a chance to meet him only once, and this is one question I asked him: that how do you reconcile the idea that for example, if you're a money manager and you get a client who's given you money, and you have other client's capital whose portfolio you are already managing, and there are things that you're owning for that client which you're holding, which you're not going to sell because you want to hold them, but you don't want to buy for them because there is no more money in the portfolio. But a new client comes in and he gives you the money, and you are wondering, now with this money, why am I not buying that stock that this fellow owns? The paradox is that he owns it and the new client is, and technically you're buying your book every day. Mentally you're liquidating your book, ignoring taxes and transaction costs. Mentally you're selling your book and buying it every day, right? So that's the paradox, that a new client comes in and you're not buying that stock for him, and this other fellow is sitting on that stock and you're not selling for him, and you're not buying, you're holding for him. So why are you not buying for him? So this paradox, I asked Charlie Munger, and he said that I can't explain it in terms of logic. There's no, actually on my blog, I have a whole section on it, what exactly he said. And I reproduced it. He said, I can't justify it with logic. There's no real logic to it, but this is the way I do it. There are all these businesses that I would not buy more of, but I won't sell them. So he believes in very, very long hold periods. So that's my answer to that. Yeah. That's one paradox, arbitrage, there's a distinction, then you have to change your way of thinking. Yeah.
Professor, lovely talk. Just if I get it straight, this is kind of like Bruce angel strategy where angels who've fallen down probably will buy. Just three heuristics or mental shortcuts I'm thinking. Would it be fair that if the price has fallen 40%, would that then?
No, I don't. It would be a good heuristic to have to create a screen in the first place.
The screen.
Yeah. Uske baad you have to do more work. That's a good place. Yeah.
Secondly, would you believe that over the next 3 years, once you decide to buy a company, probably will have about 10 or 12 of these in your portfolio, maybe 5 or 6 or something like that. But over the 2-3 year period would be a good time to get out of, or at least decide whether to exit or not.
Exiting is nothing to do with all this. It's to do with opportunities that are outside the portfolio. I don't think sell, I think switch. So something else comes by which is much more compelling, then it makes it easier for you to think about switching than selling. Selling is emotion ridden, you start falling in love with ideas and stuff. But if the moment you make it a comparison with something else, it becomes more objective. So it becomes easier to make that distinction, comparison. So again, I don't want to predict what will happen, but you see, there are so many, there's a lovely book called There's Always Something to Do. It's written by a very nice value investor. You can check it out on Amazon. And he says that, if you're a value investor, there are 5,000 companies out there. There's always something that is out of favor hopefully for the wrong reasons. And this is something which I found very interesting and intriguing and actually sometimes frustrating. People writing on Twitter, kuch bhi sasta nahi hai, market is expensive, multiple is so high, look at what has happened. We're not buying the multiple, we're not buying the market, we are buying a specific business and specific opportunity. You're not buying that, you're buying this business, this stock, this industry, this company. And look at this one thing. How many you need? You need 6, 7, 8, 10. You don't need a lot. So there's always something to do. So 3 years, 4 years ago, NBFCs are out of favor. Today, I think it's something else which is out of favor. Tomorrow could be something else. But I know human nature. So I study and teach psychology. I know that there will always be something that are deeply in favor or glamorized, and there will be something because of that they are unglamorous or unloved, hopefully for the wrong reasons. And I'm naturally graviated towards that. I'm naturally moved towards that. And I also know that something is moving from this to this. And I want to be in that space when that happens. I want to be there to see, which one of these fallen angels, to borrow your term, could turn out to be real, candidates for bounce back. There was a third point.
And the third point was looking at your past track record on an average. Would you get about 1 or 2 of these bets a year, or?
I think more than that. You don't need. It's a framework you can apply. Once you have the framework in mind, you can apply it. I think I don't think you need it's one or two. I think it's a lot more than one or two. But by the way, just to give you an idea, in the last 30 months we have made 10 investments. So three ideas in a year is what we have done in my professional work. That's about the frequency, and I think that I would love to do more if I get more. It's not like I want to do 3, I want to make it 2, I want to make it 1, or I want to make it 10. This is what I caught. Maybe there were more I missed.
Also appreciate that because let's assume you like the microfinance and you like 3 or 4 companies. Suddenly your portfolio is too overweighted towards microfinance.
I can never have a very large exposure on microfinance because it is by nature a riskier industry. So again, there are so many buffers, so the way there is the risk mitigation at the company level, which is through diversification, through risk management practices, through capital adequacy ratios, through high NIMs, and all of those things we talked about. That is specific to the company. And then there is a second line of defense for me is that what is the size of that particular business in the portfolio. So if it is like 8%, that means 92% of our money is not in that industry. Yeah, I think we should wrap up. I have to go actually. My kid has come from the US. I haven't met her. I have to leave in like 2-3 minutes.
One more question.
Yeah, one more last question. Yeah.
Last question. Thanks for the opportunity. So about ILFC, I also have a parallel thesis which I also invested around the same time. But I have a thesis which I would like you to validate. You are the person who can really validate it. That what was the role of extra budgetary allocation?
Good point.
In ILFC thesis?
These are very interesting developments. I'll step back and talk to you about much more than just one example. I'll give you a very different example. Redington, a company that we invested in long back. Apple comes to India and starts selling it through its own stores. And people say, oh, Redington is not required anymore. For Apple, Redington is just one go-to market strategy. Apple is selling through Amazon. Apple is going directly to sell through its stores. Apple is selling through Redington. And if you go to Amazon, Redington is also on Apple. Everybody is sleeving with each other. It's like very, very, every sort of relationships are like quite embedded with each other. Why am I connecting with this? We have this thing about either or. Either this will work or that will work. When the government wants to expand India's railway infrastructure, they have a choice. They can fund it directly. If they do it, there's a consequence of that. If they do it through IRFC, there's a consequence of that. Now, the question that I have for you, and what I asked my class was, IRFC is the financing arm of Indian Railways, and they have this huge, $54 billion of assets under management. This was also earlier. Now it must have grown. Why does it even exist? Why can they not do it on their own? These 29 employees can be employed with Indian Railways, and they can borrow money. It's the same skill set. They can borrow money. Why do they need to, create a new company? My hypothesis then and now is that from the Beatles song. The Beatles song is, hey, you got to hide your love away. Just change the word love to debt. By making IRFC borrow these billions and billions of dollars in a different SPV which they have created, the debt of IRFC does not form of consolidated India debt. It's a SPV. It's like Enron, not in a bad way. It's like off-balance sheet financing. In that sense, IRFC is nothing but an off-balance sheet financing vehicle for the Indian Railways, for the government of India. And it has been for the last many years. And I'm not saying it in a derogatory manner at all. It has been there for a purpose. That purpose, part of the reason I think is they don't want that to happen. That once it is there, and moreover, now that it is in the public hands, for that to, and there's a prospectus that has been issued, and they have said this is the role to play, they have put them. Of course, they will play a role in raising funds for the railways. And of course, the government of India can also do direct budgetary support. Direct budgetary support directly hits the fiscal deficit, or if they borrow it from the market, it will hit the government borrowings. They do it through IRFC, it will be off balance sheet. So they have to figure out how much do they want here, how much do they want there. It's like both will work. I don't think IRFC business model is going to go obsoleted any more than I think that Reddington is going to get obsolete because Apple has come and built its own stores in India. We have this whole thing about, oh, this is happening, the other thing is not required. They will both coexist with each other, I think. But yeah, how much earnings will, how much assets will grow, very hard to say. Every year the government tells IRFC, this is the capex plan. We'll see.